You want to play politics in the stock market, you're going to learn a very, very painful lesson. Do not buy stocks because your guy is in office. Do not hold out on not buying stocks because your guy's not in office. It's ridiculous. The stock market, you're never going to make money all the time. That's just how it is. Ask anybody that's been playing this game for a long time. Never make money all the time. Put yourself in a position, you got more income than expenses, you can continuously invest in the market and let the game play out. When we're going through a time period and the market's downtrending, everybody starts feeling worse about the economy that goes on in these shows. The stock market really dictates how people feel about the economy. Tesla numbers factually have been awful the last several years. Trash. That's not a debate. That's just a fact. There's not a company that exists in the stock market that I couldn't make a bare thesis on. If all of a sudden tomorrow everybody decides to stop spending, what do you think is going to happen to the economy? Let me ask you a question. Do you like it when there's a little drama in the stock market? Because I know I certainly like it when there's drama in the stock market. And oh, do we have drama, ladies and gentlemen? NASDAQ is down 9.6% from all-time highs, right around that 10% mark now at this point in time. The Dow Jones Industrial Average has lost 5,000 points from its all-time high now at this point in time. Remember a long time ago, as in 2025, do you remember what was talked about in the stock market last summer into the fall time? It was things like, is the stock market overvalued? How overvalued is it? It's richly priced. We're in a bubble. All those sorts of things. Let me just say that all of that stuff has been killed off now at this point in time in regards to the stock market. Now what people are talking about is not, is the stock market overvalued, bubble, all those things. Now there's recession worries. We have this word right here. We call it the rod wave. Okay, that word right there. We're dealing with that. CapEx is completely out of control. These are the subjects that are dominating the stock market this year and why we're seeing so much weakness. We've seen trillions of dollars wiped off the stock market just in the past several months, right? So this is a very rare Friday upload for me, okay? But given we got market drama, I'm going to do what it takes. And if that means a Friday upload, we're doing a Ferrari Friday upload, ladies and gentlemen, okay? So 3 core subjects I want to get into in this video here today. Number 1, the economic worries. Are they legit? Are we going to go into recession? Are we not? I'm going to share my opinion perspectives there. Number 2, as a huge move I'm looking to make in my portfolio, a massive sell. And when I say sell, I'm talking 100%. And we'll talk about where I'm looking to put that money. Additionally, third subject we're going to get into here today is how much lower could the stock market go? We've already seen 5,000 points knocked off the Dow. The NASDAQ's down almost 10%. How much lower could we even go? Or are we near the bottom right now? We'll get into all those subjects here today. I hope you guys enjoy this Friday upload. This is so dang rare for me. One thing and one thing all I need from you, just smash that like button. I hope you could do that for me. I appreciate you in that biggest way for every single person that does that. Also, make sure you subscribe to the channel. We are now over 920,000 subscribers strong on this channel. I appreciate each and every one of you for being here, okay? Alrighty, ladies and gentlemen, let's get rolling. Listen. Unemployment rate. The unemployment rate right now is right around, we can call it about 4.5%. Now, with the unemployment rate, a lot of people look at this as a lagging indicator. They say, okay, it's 4.4%, but if the economy gets a lot worse, next thing you know, that'll jump to 6% quick, right? That's a fair debate. That's a fair debate. But as of right now, at least, it's about 4.5%. And I feel like that's a pretty good unemployment rate. Like that's what you should expect in a decent to strong economy, right? If you're in a weaker economy, you really go over 6%. If you're in a horrible economy, you'll approach like a 10% number. That's like disaster, right? Like the only time we really had like a 10% number or above was Rona, when we had all the shutdowns, and I'm talking about in recent history at least. Rona, when we had the shutdowns, obviously, right? Mass amounts. I mean, heck, my city I live in alone, Las Vegas, like the whole strip closed, right? So anybody that had any job in relation to strip, like, you know, was laid off during that particular time. And then the other time period in recent history we had an unemployment rate reach around 10% or above was in the Great Financial Crisis. So that's something that very rarely happens. But, you know, 4.5%, that's not too bad, right? Now, there's a very underrated thing I like to look at in regards to the economy, understanding money, and money velocity. This is very important. The velocity of money is the frequency at which one unit of currency is used to purchase domestically produced goods and services within a given time period. In other words, it is the number of times $1 is spent to buy goods and services per unit of time. If the velocity of money is increasing, then more transactions are occurring between individuals in the economy. This is something you really want to see. Listen, I'm fortunate to have a lot of money nowadays, right? Okay, I could sit on all my money. I could decide to not ever go out to eat. I could decide to not go on vacations, never buy new cars, never buy new homes, never buy new furniture, never spend on landscaping, and so I'm just hoarding all the money and sitting on it. That doesn't do good for the economy. We all have to be spending with each other so we can keep the show going, right? Otherwise, everybody starts doing worse. And so velocity of money is one of the most underrated things, I think, in economics in general and with the economy in general. And the worst thing that can happen is everybody decides to, if all of a sudden tomorrow everybody decides to stop spending, what do you think is going to happen to the economy? It's going to be a complete disaster. And what do you think is going to happen very shortly after that? Everybody's going to lose their job. No, there's going to be no jobs. There's going to be no taxes. There's going to be no nothing, right? Just civilization over. The show has to go on by people spending and that money getting spent around and around and around, right? Now, look at this. This is very, very fascinating. Do you see the trends I see? This is crazy. Check this out. In the mid 90s, basically, velocity of money kind of peaked out right here, right? And then we went through a several decade just kind of lower lows, and you had some bounce backs in velocity of money here and there, right? This was prior to the great financial crisis, but the overall trend was clearly down. There's not even a debate. The overall trend was clearly down. And finally, the trend ended during Rona. Like crazy, right? The trend ends during Rona, and since then, we've been actually in a nice uptrend. Now, here's where things get very interesting about this velocity of money. Look where we uptrended to. We've uptrended just roughly in line with where velocity of money used to be. So it's not like we got some new crazy all-time highs here. It's just worth noting, right? So the velocity of money, could we be at a peak right now and about to head down more? That's a debate, right? So just something to keep an eye on in regards to velocity of money. Next thing I'm showing you is the Federal Reserve's balance sheet. Now, this is another thing that's very interesting. I don't know how many people have been watching this. The Fed balance sheet peaked out right here at basically the beginning of 2022, right? Now, inflation was going crazy at this particular time, and the Fed decided they needed to start basically shrinking the balance sheet. They just started to raising interest rates at it, make a whole host of decisions. Now, I believe this increase right here in the Fed balance sheet, I believe that was around SVB time. And we had some regional banks that collapsed. If I recall, that was the kind of little pickup there. But the overall trend in the Federal Reserve balance sheet is lower and lower and lower and lower and lower, right? In terms of shrinking the size of the balance sheet from its ridiculous, about $9 trillion there, during that whole insanity. Now, something really interesting's happened recently. Look at, just in the past few months, this has actually started to increase. So the Fed is actually starting to increase the balance sheet again, which you could look at as, some people could look at that as, oh, that's a good thing. That means there's going to be more money sloshed out there, more money to go around. But it is interesting that at the same time, the Fed has started to actually increase the balance sheet a bit, we've also started to downtrend the stock market. That's interesting because usually you would think, if anything, it was the opposite. If anything, you would think, oh, the stock market had to just go down this whole time, and now the Fed balance sheet's increasing again. Now the stock market goes up. It doesn't really work like that, right? But it does make you think, the Fed's starting to increase that balance sheet again. Are there things going wrong? Because usually what happens is when times are good, the Fed can shrink the balance sheet, and when times are bad, times are tough, the Fed starts increasing the balance sheet. Keep in mind, these trends can be going on for quite a while, right? This was a trend that went on for a significant amount of time in terms of, shrinking the balance sheet. Then we had Rona, and then that went through a several-year up cycle for increasing the size of the balance sheet. Then we went through a several-year down cycle for the Fed balance sheet. So if you had a guess, we might be on a several-year increase in balance sheet, which means maybe there's something coming, right? Just something to consider in regards to that. Okay, next up here, government jobs. Listen. It's been very messy the past year with government jobs, right? We had Doge, then we had government shutdowns for quite a while. Now we have TSA. I'm so happy I'm not flying, and I hope none of you guys have to fly anytime soon. I've heard it's a disaster out there. This is a picture. It's posted on X. By the way, if you ever want to follow me on X, I have it always linked in the description area down there. I post stuff almost every single day on X. But I believe this was the Houston airport. It's out of control. Right? Look, I see something like this, and you know the first thought I think of when I see this picture right here? I don't want to fly anywhere. So even if I was thinking like, maybe I'm gonna book a flight in the next month or two to fly somewhere and go spend some money in a different city. Oh, no, thank you very much. No, I'm not dealing with all that. Forget that. And this has to do with TSA employees and all those sorts of things, right? Check this out. Massive TSA lines at LaGuardia Airport in New York City. They stretch into the parking lot. I mean, yeah, if you can avoid an airport in the short term, avoid airports in the short term. Or you better be ready to binge watch a lot of my videos and while you're in line, because it might take you, 3, 4, 5 hours. Like, who knows? This is ridiculous in regards to that whole situation, right? So that's something that, if people are looking at this, they're like, why do I want to travel anywhere? Why do I want to spend money? And then you start worrying about money velocity slowing down. Money velocity slows down. It's not a good thing overall. It's not like something that ends the economy. It's not ideal. You want to have money moving around, circulating, right? Now, what about public perception? So public perception suggests the U.S. economy is getting worse. Well, with 59% of Americans holding this view as of March 2026, driven by rising gas prices, that's not a surprise, and inflation. However, economic data presents a mixed picture. Although consumer sentiment is pessimistic, the economy has continued to show growth. Inflation's a big worry, right? Inflation has been an issue with the consumer, and the consumer is just a fancy way of saying Americans, right? Or, people even around the world, but I'm really talking about Americans here. Inflation, it's been an issue for years. It was pretty much a non-issue for a bit, and because gas has all of a sudden gone up so dramatically again, it's an issue again. And literally, inflation numbers were done. But because now gas prices have went up so much, it's now, potentially going to bring up the CPI. It could potentially even bring up the PPI, the producer price index over time as well. Because, at the end of the day, when we're talking about oil prices, that goes into everything. So, and then there's worries about, okay, inflation goes higher. Fed has to remain with higher interest rates than people would like, right? I mean, it's just not a good dynamic. It's not a good dynamic. So you have a situation here where the 10-year has been going up. Meanwhile, there's a lot of worries about the economy getting a lot worse. What is that? If you have an economy that's getting worse and you have rates going higher and inflation going higher, what is that? It's an ugly word. And you learn this early on in economics when you go to university. Hopefully you learn it before you go to university, but most people don't learn it until you go to university. Most people might not even know it. It's called stagflation. If you have a worsening economy, higher inflation, higher rates, it could be very, very ugly. So you can't say we're in stagflation right now, but you can say there's ingredients that make you scared that we could go into stagflation. And that's something no one wants to see. People say, okay, we can deal with inflation, but stagflation? Higher prices and, a bad economy? Oh no, that would be disastrous, right? We got through 2022 in that mess. You know how? There was such a huge pumping of money out there in 2020 and 2021 that the economy was able to stay alive in 2022 despite that ridiculous inflation the consumer had to deal with in 22 and then into 23. There was such a money pump out there. Also, you had the reopening, so there was a lot more jobs that came back, and so we were able to stay afloat. If it wasn't for that, we would have been in a lot of trouble. But you could also say we would never had that insane inflation without the crazy money pump out there and all those various factors. And then commodities going on a several-year insane bull cycle from the lows they hit around that April-May timeframe of 2020 into 2022, essentially, right? Now, this is the United States Michigan Consumer Sentiment. They've been doing this survey for decades. I just want to show you the last decade, the last 10 years, okay? Now, if you're above a 95 reading for consumer sentiment, that's great. That means you got a truly great economy. And I can say the best economy, I feel, and when I say the best economy, I'm talking about for the masses, The average person. I don't care if you're rich. I don't care if you're middle class. I don't care if you're even, under middle class. But the best economy I've ever seen in my adult life, which my adult life started in 2008, was, I would say, kind of in that 2017 to 2019 timeframe. We, had very low unemployment. Inflation remained pretty darn low. There was a lot of optimism around the economy in general. And man, I just look at that 2017 through 2019 timeframe as kind of like my adult life's best economy we ever saw, right? And then Rona happened. And ever since then, it's been a mess. Basically, if you're in the 85 to that 95 range, you've got a very good economy and consumer sentiment, right? And remember, it's consumer sentiment is really made up of, can you get a job? Or do you have some money left over at the end of the pie, right? That brings up consumer sentiment. If people have good jobs and they're not being sliced and diced by inflation, they got some money at the end of the month so they can go on vacation, they can do this and that. And I'm talking about the average person. That's what really makes consumer sentiment high, right? If you kind of go in that 75 to 85 range, you're in like a meh economy, I would call it, right? From at least a consumer sentiment perspective. If you go in that 65 to 75 range, you have bad consumer sentiment, which means you likely have a bad economy, or a combo of like, people have jobs, but they have nothing left over because they've been sliced and diced by inflation. And if you go under 65, you got a disaster. Listen, over the past several years, we've been in disaster, like straight up. And we're in disaster right now as well. Now, with that being said, unemployment still remained relatively low. Companies have still been able to put up numbers even with disastrous consumer sentiment. But if you want to look at this, we can look at everything from a positive or a negative perspective. If you want to look at it from a positive perspective, listen, we got a long dang way to climb. And it can't get much worse than it is. Like literally it can't. Like consumer sentiment's so bad, it can't get much worse. And so consumer sentiment could come back in quite a significant way over time, right? Step by step, step by step. Okay, next up here, data centers. Now, this is really good news. Really, really good news, okay? All these companies are spending a fortune. We all know that. A lot of that money's ended up in Nvidia's pocket, but you have to build these massive data centers, and they're being built all over the United States by so many different companies, right? Obviously, Amazon, Google, Meta, Microsoft, companies like that are some of the big ones. But these insane data centers don't just magically get built. They're built by humans. And humans using massive cranes and, machinery and Caterpillar equipment, all this stuff, right? And so when you have these huge data centers being built, it creates a lot of construction jobs and a lot of jobs in general. And so that's the good news we have for this year and at least into next year is you've got data centers all over the United States of America being built, and these don't build themselves. You need a lot of people to build these. I watched the TSMC facility go up in Arizona because I have a house in Arizona that's probably about, let's call it 15 minutes away from the TSMC facility, right? And I watched that be built when we were kind of using that house as like a vacation home. It was unbelievable. Unbelievable. The amount of jobs this TSMC facility produced. And they're building more facilities around it as well. So do keep that in mind. But it was shocking. Like I would go there and it was just vehicles everywhere from how many construction workers would be on this project. So stuff like this, TSMC facilities, all these data centers being built all over the United States, there's no doubt that's very, very good for the economy. That means lots of construction jobs, lots of jobs from indirect jobs, and then those go ahead and create more jobs off of those, either directly or indirectly. So that's a really good thing, right? If Amazon and Meta and Google and all these companies were using the money just for share buybacks, that's not good. That means the companies are just, basically using all that money and just pumping it back into share buybacks. It doesn't really do anything for the economy, right? It does something for the stock price. Earnings per share can skyrocket in that dynamic because you have share count going down while your net income's increasing. Phenomenal. But it doesn't really do anything for the economy. All these companies want to spend all the money coming in, right back into the economy. Hey, that we're talking, right? Now, another thing I like to tell you guys, you got to always pay attention to. One of the most important things if you want to judge the economy is new housing starts, and the housing market in general, is very important to the economy. But new housing starts is huge because every house that built, oh my gosh, the amount of direct and indirect jobs that go into building a house is unbelievable. It's unbelievable. Like how many trades and how many companies make money off that? So in regards to this, housing starts have not been in the best place the past few years, and it's been getting worse. But if you want some optimism, the past few months have gotten better in regards to housing starts. So, or I should say the past few quarters. So, there might be hope in regards to this. Just something to kind of keep in mind there. Now, this brings me to a phenomenon in the stock market, because the stock market is talking so much about the economy right now, right? And it's what I just showed you there, the chicken or the egg, right? What came first, the chicken or the egg? And it's like, dang, that's a good question, because the egg would have to come so then the chicken could be born. But then you're like, well, where'd the egg come from? Like, that's kind of confusing. It would have to come out of the chicken, right? So, yeah, what did come first, the chicken or the egg? It's a confusing little dilemma, right? And I have the same dilemma in regards to stock market, where every time it seems like the stock market goes down, people worry about the economy. And so you got to ask yourself, are people in the stock market worried about the economy because the stock market's going down? If the stock market wasn't going down right now, maybe there wouldn't even be any concerns about the economy. Maybe everybody would be fine about this, right? So that's an interesting dynamic. The way I look at it, in my opinion, you cannot make a good prediction right now on if the economy is going to get a lot better or a lot worse over the next 6 months. I just don't think it's one of those time periods. You have too many mixed signals. You have a jobs picture that's not horrible, but it's also not that great right now, right? You have a consumer sentiment that's in the dumpster fire, which you could look at it as a perspective of like, oh man, it's so bad. Or you could look at it from a perspective of maybe things could get a lot better over the next 6-12 months. So I just look at it as, I don't think you can make a strong case for the economy being really bad right now or really good right now. It just is what it is. And we'll manage and we'll move through it. Company earnings are pretty good. Are they off the charts great? No, but they're pretty good. We just had earnings season. We're about to get another earnings season. So, that's kind of where things are at in regards to that. I think it's a phenomenon where stock market goes down and everybody in the stock market starts feeling worse, and then they start looking at everything from a negative angle when it comes to the economy. That's just what I've seen in my 17 plus years being in the market, right? Okay, before we get in a huge move I'm looking to make and what's going on there, I want to let you guys know I recorded you last weekend a 35-minute workshop on how to manage your portfolio at every stage of wealth. I don't care if you got a few $1,000 to your name, tens of thousands, hundreds of thousands, or millions. I got a video that breaks it all down, what to do at each stage. It's a 35-minute beast. If you want access to that, it will be the pinned comment down there. Click on that, and then I can send it over via email or via text. However you want to receive it, we can send it over. But I think you guys really, really enjoy that workshop. It is absolutely free to access. Okay, so what's a big move I'm making? What am I up to here, and why? And where's that money going to go? Well, TSLZ. So this hedge, I'm looking to sell it all. It's about time. Listen, if the market's down Monday, it's moving time. Moving out of TSLZ. Moving out of it. So this is a hedge. I already took big profits in another batch of shares I had in this ETF. And I'm looking to take the rest on Monday if the market's down, that is, right? So $9,500 is what we're sitting on for total gain here, 21%. It's been a good hedge for me overall in the past few months. And let's just be honest, since I made this hedge, almost every stock's gone down. I mean, there's a few that have gone up, but I would say like the far majority of stocks are down, and most of them are down huge. So I feel thankful to have made a big profit on this, right? 20+% in a time period when I've seen, the amount of stocks that have gone down 20% plus since this time. Oh my gosh, that list is a mile long. So I'm looking to flip out of this. Now, listen, as soon as I sell it, that means Tesla's really going to crash. That's how it works. I feel like every time I get out of a hedge and take my profit, the real crash happens after that. And I'm like, yeah, why didn't I keep it longer, right? But the bottom line is, whenever I make one of these hedges, I really don't want to count on a massive crash, right? I'm counting on a market to downtrend, a correction for me to make good money and move out of the position, right? And so, but yeah, I wouldn't be surprised if after I end up cashing, because like I said, if the market's down, let's say the NASDAQ's down 0.5%, 1% Monday, and Tesla's down 1% or a few percent, I'm moving out. I'm bye-bye TSLZ. And so Yeah, I wouldn't be surprised if then it really crashes. And then I'm like, oh man, remember I took $55,000 out of that, and then and then it became $100,000, $75,000. Like, that's how it works. Duolingo, I can't. The Duolingo put options, I would have made $300,000 more in profit. $300,000 more in profit if I just held through. I took a huge profit initial. Thought I did so amazing, and oh gosh, was the big money ahead. Oh, anyways, that is what it is, right? Okay, so where am I looking to put that money, TSLZ, after I sell and get my proceeds of, we can call it 55,000. Hey, hopefully Tesla's down a decent amount Monday, and maybe I can get 60,000 or something like that. Where am I looking to put that money? Well, in a few stocks. So, real quick here, I think this is cool. Fidelity always puts this like 52-week range for your stocks that are in your portfolio. Look how many of my stocks are at 52-week lows or close to 52-week lows. I like this. This setup is very, very nice, right? This means when we do snap back the market the other way, and we can debate if that's going to be a week from now, a month from now, 6 months from now, 9 months from now. But when we do snap this market back, oh my gosh, are you going to watch the public account make a move? Oh my gosh, are you going to watch it make a move? So I don't even have one stock that's close to 52-week high. Google's the closest thing. Google's at 300 right now, and its 52-week high was 350. That's the closest one I have. AMD's 52-week high was 267. That's 201. Yeah. Oh my gosh, the snapback in this portfolio is going to be insane. Absolutely insane. So now where am I looking to put that TSLZ money? Well, I would be looking to buy some more Honest, HNST. I'd be looking to buy definitely some more American Express. I bought some American Express actually this morning. I'd be looking to buy some more Adobe. I would love to buy some more Nike, but I might be good on Nike with where I'm at with that position in the public count. I don't mind buying some more Nike and other portfolios as well. But I would say Honest, I would say American Express, I would say Adobe will kind of be my main focuses when it comes to public count buys there, right? So anyways, that is what it is. Okay, third subject up here, how much lower could the stock market go? I think that's a fair question. Everybody's looking at it like, dude, how much? How much? Okay, listen. This news just came out a bit ago, right? Trump says he doesn't want the rod wave, doesn't want a rod wave ceasefire, right? He's considered winding down military operations. Now, some people are going to say that's smart. Some people are going to say T-Man's tacoing. By the way, most people that say T-Man's tacoing, almost everybody I know, like at least 80-90% of the people I know voted for Trump. And like they're all the ones that are saying Trump's tacoing again, essentially. So it's kind of funny that like even people that vote for Trump are basically saying he tacos in regards to these situations. But listen, the Dow's lost 5,000 points. Everybody knows Trump looks at the stock market heavily. He makes it no secret. I mean, he posts about it all the time, right? He's got, what is her name? Pam Bondi or whatever was talking about it when the Dow was recently 50,000. And she's like, the Dow's over 50,000. You should be paying attention to that, not the other stuff. So T-Man, if Trump's kind of ready to call this one off, the market could look at that as positive. But I think the market really wants to see the actions, because the market could be faked out here where like, oh, Trump says a lot of things, but you got to look at the actions. It's like just because Trump says, might do this, might do that, that doesn't mean he's doing it. And if you've paid attention the first term and even the second term so far, that's what you've seen, right? Sometimes he said he's going to do this and he does something else. So just because he says, oh, we might be winding down military, that doesn't mean they're going to. You've got to watch the actions. And so the market will be watching the actual actions. Is there anything actually going on here with actually pulling, military operations, winding them down here, or is this still going to be an ongoing matter, right? So that's what's going to come down to. If there's a real wind down, then, market might be able to start bouncing back and we might already be hitting lows right around here. If it's not, then I think the market will continue to be concerned until there's actions proving what he's talking about here. So that's the way I would look at it. Yeah, that's the way I would look at it, right? And so we'll see what happens there, but the actions will matter a lot more than the words. Now, additionally, you're getting a lot of stocks that just really screaming deals. Now, I'm not just talking about like opportunities I like in the market, like Elf and like Celsius and some of those stocks, right? But I'm also talking about big dogs that everybody pays attention to. I'm talking to Mr. Softy, Microsoft. Talk about that a little bit on, I think it was a reaction channel yesterday. Forward P on Mr. Softy's 21. Meta's a 19. Forward P, these growth rates are insane for these companies, like 15, 20% type revenue growth. And 21, 19 forward Ps. That's interesting. Amazon 26 forward P for Amazon? I don't know about this. So the bottom line is even very, very popular stocks like Microsoft, like Meta, like Amazon are now extremely attractively priced. Now, are they steal deals? No, I wouldn't call them steal deals, but I would call them very attractively priced if you're somebody that wants to be along in these sorts of stocks. And when you start getting these sorts of companies very attractively priced, it's hard to push the market down much more, right? Now, could Meta go from a 19 forward P to a 15? Sure, all things are possible, right? It just gets harder and harder to push them down. I'll say that as time goes on here. So all things are possible. Meta's got revenue growth rates of 20+%. Now, here's the thing. If Meta revenue growth all of a sudden implodes, and let's say Meta goes from 25% revenue growth where it's been recently down to 10%, 5%, okay, we got problems in Meta. Meta could easily go a lot lower, right? Because they got the crazy CapEx, and then all of a sudden if revenue's only growing 7%, night. But these stocks are attractively priced now at this point in time, right? No, I put this out to my private stock group recently. I said, always stay in abundance mentality. You can go through these time periods in the stock market where, your portfolio is not hitting new highs. Maybe it's even hitting new 6-month or 12-month lows. And you can start thinking in scarcity mentality and those sorts of things. Don't go over that side. Stay in abundance mentality. There's no shortage of money out there. The stock market, you're never going to make money all the time. That's just how it is. Ask anybody that's been playing this game for a long time. Never make money all the time. Sometimes you're going to go months, sometimes you'll go years between setting an all-time high in your portfolio and setting a new all-time high. And you have to be okay with that. And it doesn't matter how great of an investor you could be the greatest investor ever. And still, there's going to be time periods when for months or years, your portfolio is not going to hit a new all-time high. And you have to be okay with that. Stay in abundance mentality, folks. There's plenty of money out there. There's plenty of money to be made. And when it comes to your positions, if you own great companies and you bought them at fair prices or undervalued prices, it will be reflected over time. So stay patient in this game as well. Patience is everything in the stock market, okay? Pin a comment down there today. Once again, get that free workshop. You can send it over via email or via text, however you want to receive it. That one covers basically how to manage a portfolio at every stage of wealth. I think you guys will really enjoy a lot of the tips and tricks and tactics and hacks I teach you in regards to that workshop there. First off, we're going to look at some of the stocks in the S&P 500 that have done the worst so far this year and talk about some of these stocks or opportunities. I even want to talk about some stocks we don't really talk about much on the channels, like Mr. Softy, Microsoft. We almost never talk about Microsoft. Apple, we almost never talk about Apple. I even want to talk about some of those stocks, some of the banking stocks that have been getting hammered so far this year. So we're going to get into a lot of that at the front of this video and talk about if there's some opportunities there or not. Okay. From there, I want to share my entire buys watch list with you guys and talk about which ones I'm most excited to buy or not in regards to that. Then I want to react to this video, the reaction to rising oil prices and the hawkish Fed. Looking forward to this discussion and sharing my opinions and perspectives there. And then the Micron CEO. This is a very controversial stock right now because the numbers are shockingly good. They blew numbers out of the water last night. The guidance was like $10 billion ahead of what analysts thought. It's crazy. And yet the stock was down big here today and people are like, what is going on? Like, can any stock go up? If Micron can't go up with those shocking numbers, like what stock can go up in this market, okay? So I want to talk about if that's an opportunity or not in the market right now. I appreciate y'all for joining me as always. One thing only I need from you, if you could just smash that little like button. I appreciate that in the biggest way. That's all I need from you. I hope you can take 1 second out of your day and just smash it. Additionally, make sure to subscribe here to the channel if you want to see more of my videos. I think we're at 130,000 subscribers, and I got a Christmas present for you. It's called a Christmas present in March. It's a free brand new workshop I just filmed this weekend. It's 35 minutes long. It goes into managing a portfolio. So I don't care if you're watching this and you got a $5,000 portfolio, a $25,000 portfolio, 100,000, million. I talk about every single level and basically how to build it and scale it in the best way possible as somebody that's gone through all the different ranks over the last 17 years, starting with hundreds of dollars and obviously multi-millions. So yeah, That's a free workshop for you guys. Can send it over via email or via text, however you want to receive it. You can receive it. Okay. Alrighty, ladies and gentlemen. So let's talk Microsoft. I want to talk Microsoft. We don't ever talk Microsoft. Let's go, baby. Microsoft. This is a stock that's down about 20% this year, right? When it comes to Mr. Softy, listen, is their entire business model about to be upended by AI? I'm not so convinced of that. I'm just not. Like, is everybody going to get rid of Microsoft? I mean, all things are possible. I just don't think it's super realistic, right? Like the entire suite of products? Come on. I don't know. I just can't see that. Additionally, the Azure business has been growing rapidly. That's an incredible, like the growth rates Azure has been having. I almost kind of wish AWS, because as an Amazon shareholder, had those sorts of growth rates. It's been phenomenal. So when I look at Microsoft, gosh, I'll be honest with you guys, the stock's a buy. And this is not usually a stock that I would be interested in, but I think the stock is a buy. Let's go ahead and pull up the charts feature here on good old Mr. Softy. We're looking at 1000xstocks.com here. Look at Microsoft. I mean, you know, that's the type of revenue growth you dream of right there. Gross margins are incredibly strong. Net margins are incredibly strong. Trailing 12-month earnings per share. I mean, these are really impressive numbers. Free cash flow, yeah, probably going to go down, obviously, because of all the CapEx spend. Free cash flow per share. The historical P is very low right now, and this has it at 23, but, well, the forward P actually is like 21 on it, but you're getting this at a very low historical PE here. The operating cash flow on a trailing 12-month basis up to $160 billion. Operating income on a trailing 12-month basis, $142 billion. Shareholder equity is basically all-time highs, right around $400 billion. Shares outstanding, if anything, there's been a little trend of bringing that down here. So, I mean, Mr. Softy's a buy. It's as simple as that. I'm kind of tempted. I never bought Microsoft stock in my entire investing life, but I'm actually very intrigued right now. Apple. When it comes to Apple, this is an interesting one because now people are debating that maybe they have the best strategy in regards to AI, and that's because they're the device owners. They don't really need to spend the crazy amounts of money that these other companies do. Apple trades at a forward P of 28. You know, yeah, I don't think it's a bad buy, Apple. I think it's a fine buy. I just think Microsoft has more reward potential. I'll say that. If I was to pick between Apple and Mr. Softy, Microsoft. A lot of these other stocks we talk about quite a bit, like Amazon, Nvidia. Obviously, MU's had an incredible year. If we look at stocks like JP Morgan, which is really the only banking-related company I would ever own outside of SoFi, right? JP Morgan, forward P of 13. I think a lot of the worries with JP Morgan is a slowing economy, an economy that gets worse, a recessionary economy, inflation slicing and dicing the consumer, and maybe JP Morgan earnings are down, you know, for the next 18 months or something like that. I think that's where the worries come in with somebody like a JP Morgan. Berkshire Hathaway, I think Berkshire Hathaway is a decent buy right now. Software stocks, there's a lot of buys in software stocks, right? CRM, Now, Adobe, there's a lot of buys in that space. As far as healthcare, not really my space when it comes to that. Travel, Booking Holdings, okay, I'll be honest with you guys, okay? I'll be honest. Listen, some of these travel-related companies that are kind of intermediaries, they kind of scare me a little bit. Those are ones I actually legitimately am a little fearful in regards to those companies with AI. Because it does look like a lot of people are kind of searching for trips and kind of doing it through AI now. And it kind of worries me about pricing power with these companies long term. And what if, I don't know, I think that's one space that you can actually have a lot more legitimate concerns about AI disrupting is some of these intermediate companies like Expedia, like Booking Holdings, some of those, right? And I wouldn't say they're done for. It's just if you a little more fearful, I'd be a little more fearful of that, right? Nike's a great buy. We obviously talk about Nike a lot. Look at a company like Ulta. Ulta's had a tough year. A lot of the beauty companies have had a tough year. And these are great companies, by the way. Great companies. But if we look at Ulta Beauty, forward P of 19 here on this stock. This year, expected earnings per share growth is going to be down for the company. Ulta, I mean, I like it. I just don't love it. I like it. But yeah, I mean, at the end of the day, if you told me I had to go buy Ulta today or buy Estee Lauder, I'm going to buy Estee Lauder. Like that, they control their own destiny. Like they have such successful brands, you know, if you can't buy it at Ulta, you'll buy it somewhere else, right? Elf. If I had to pick Elf today or Ulta, once again, I'm going Elf. Elf can be bought everywhere, right? And so I just feel a lot more confident if I'm going to buy something in the cosmetics industry, the beauty industry, I'm going to go with an Elf or I'm going to go with an EL over Ulta. Not that it's a bad stock. Okay, so let me share my possible buys watch list with you guys now at this point in time. Hey, look at who's up there. Added Meta. Yeah, Meta's on there. You know, Meta, I'm going to be honest with you guys regarding Meta. Meta would be pushing close to $1,000 right now if their CapEx wasn't so ridiculous. The CapEx ruined it for the stock for this year. Not to say the year's done for Meta. It's just like this stock was destined to be $1,000 stock this year, or at least very, very close to $1,000. And because the CapEx is so ridiculous and people don't have, the problem with Meta is not only are they going to spend so much that the depreciation is going to hit massively over the next several years and hurt earnings per share growth, but people are confused on if they're actually going to get a good ROI on this spend. And it's a fair debate. You just saw Meta's kind of shutting down the Horizon Worlds game, right? Which people are like, look at how much Meta spent on this. And, you know, and so I get it. It's valid concerns about like, okay, they're going to spend whatever insane amount, $130 billion or whatever crazy amount they're going to spend this year. And people are wondering if they're even going to get back a fraction of that. It's a fair thing. And so that's just holding back Meta in a massive way. If they came in with a much more modest number, people give Zuckerberg the pass and say, you know what, let him have his pet projects. If he's going to waste $60 billion, go ahead. That's fine, Zuckerberg. Do you, boo. But when you come in with 130 billion, people are like, whoa. Basically, all the money that comes through the door is going right back out in the spend. Nah, we're not okay with that. And that's why that stock has had so much trouble. I mean, just incredible amounts of trouble, right? So until people are clear about what all this money's going to, it's in a tough place, right? The Hood, I'm interested in buying the Hood. At what price though? Well, 55 or below for the Hood. I wouldn't mind buying Hood when I'm confident Bitcoin is kind of bottoming. And the thing with Bitcoin is I'm not confident Bitcoin has bottomed. If you look at the Bitcoin cycle, there's supposed to be a bottom for Bitcoin around Q4. So until you get a confident bottom in Bitcoin and Ethereum, Hood stock's not going to bottom. The bottom line is if Bitcoin and Ethereum keep going down the next 6 months, Hood's going right down with it, right down to Chinatown. If Bitcoin goes down to 40,000, 30,000, Hood's going down to 50 or below. There's just no debating that, because that will likely also mean the NASDAQ pulled down as well. Assets under management pulled down. There's going to be, user growth would slow massively. The more damage you get in the market, especially if it's slow damage, people are attracted to the stock market or to crypto if there's a massive crash, because then people feel like, oh, there's a huge deals out there. There's been a crash. When you have a slow drifting down market, which is what we actually have right now, right? If I look at a lot of stocks that kind of peaked, they peaked around Halloween last year, like October. Some peaked even before that. Some peaked last summer. So you had kind of a peaking in a lot of stocks between, let's call it summer and fall, right? And ever since then, we've just kind of been slowly downtrending. It's no crash going on, but it's just slow downtrend. Dow drops 3,000 points this month so far, right? 19 days into the month. And so it's just drifting down. You get bounces and then just, and it seems like these stocks get a bounce and then they go lower. And that's the market you're in right now. And when you're in that market, a lot of people don't get involved in the market. It's a great time to be a buyer because you want to buy the whole crash. That's the thing. It doesn't matter. We talk 2022, you should have been buying the whole year of 2022. If we talk 2008, you should have been buying the whole year of 2008. You got to buy the whole crash and then the whole recovery. You buy the whole thing and you get insane steal deals. Like, I don't care which one you look at, like that's always how it ends up turning out to be, right? So Hood, I could be interested in it, but it's still not here. There's too many other opportunities in the market, right? PayPal 44. Yeah, PayPal, we just got to get more clarity on the business model moving forward. My guess is they're going to try to sell off pieces of the business or sell the whole business to somebody else, but we'll see what happens with that. SoFi is a steal deal in my opinion. I spoke about SoFi stock on the main channel recently. What video did I do? Ooh, I think it was a video called 7 Stocks to Buy and Hold Forever or something like that. I did a video on the main channel recently, and SoFi was one of the stocks featured on there. Amazon's always a buy. Amazon would be 250 plus right now if it wasn't for what? The crazy CapEx spend. They're another one that came in with just a silly number. It was like $200 billion, something ridiculous. People are like, what? So, and we haven't seen the AWS type of growth yet that you really want to see if you're going to come in with a $200 billion CapEx number. We need to be seeing mid-20s, maybe even push into the 30s AWS growth. And then people will give the pass on like, okay, we get it. Like, yeah, they're spending a lot. All right. Estee Lauder's a buy. Anything under 100, you got to step in and buy that. Now still a buy. It's not as good of a buy as it was a few weeks ago, but it's still a buy. Whirlpool's very interesting to me at 54 now at this point in time. Early Whirlpool. No one's been moving for years, and I believe that does change over the next few years. And so Whirlpool's a stock you want to buy. Micron. We talk about Micron. When's the best time to buy Micron stock? Is it right now? No. Doesn't mean, by the way, you can't make money on Micron stock moving forward. I'm just saying, like, right now it's not the best time to buy. You want to buy Micron when everybody's negative on it, when the prices they're getting are crap and the stock's gone through a crash. That's when you pick up Micron shares. Very cyclical related business, right? Whirlpool. Do you want to buy it when everybody's out buying homes? No. You know why? Because the stock's going to be at like all-time highs. The earnings are going to be as good as it gets. You want to buy it when no one's buying homes and the real estate market is completely dead. What do we have right now? A completely dead real estate market. We've had it for several years now at this point in time, right? And so that's where something like a Whirlpool actually is very intriguing to me, because I'm like, the stock is, it's not quite as bad as it got during the great financial crisis with pricing, but it's not that far away. And so Whirlpool actually has me very, very intrigued. Very, very intrigued as a bounce back play over the next several years. Nike, huge buy, been a huge buy. RH is very intriguing to me. They just have a trash balance sheet, and that scares me. And also, where are the earnings at? I checked last night, and I still don't believe they've announced that they're going to have earnings. I'm still waiting. Like, come on, RH, get it together. That's a little scary. So RH I'm interested on watching for right now. I'm more interested in actually Whirlpool. Adobe, a buy. No doubt, no debating that in my opinion. American Express. Oh, do I love American Express right now? Oh, do I love it. This is a stock I could buy heavily over the next several months. AXP, 16 forward P for American Express. Anything under a 20 forward P for American Express, I love. And the further under 20, the more I love it. That's a great company. Great company. That's one I can hold and sleep very well at night, right? Fubo, the Tubo, it's gone down the Tubos, $1.15. That's another one. I think more people have more clarity around the business model as the year ticks on, and you'll see momentum there. Balance sheet's better than it's been in a long time. Income statement's better than it's been in a long time. So actually probably the best it's ever been, just to be quite frank. Cake. I love cake. I love cake. I love cake so much. Yes, I really do. Cake's at a forward P of about 14 on this company. Right? I understand recessionary worries, those sorts of things. Who cares? Like cakes, they build that company for the next, 20, 30, 40 years. People are still going to be going to Cheesecake Factory in droves in 10 years from now and 15 years from now, right? The flower childs they're building right now are going to be crazy busy 10 years from now, 20 years from now. And same thing with the North Italia. It's like, the economy goes up and down, gas prices go up and down, conflicts go up and down, presidents go up and down. Next one up here, Bath & Body Works, BBWI, Bath & Body Works. Yeah, this one has me pretty intrigued. I like Bath & Body Works here at 20, especially if it goes below 20, which it's not far off of going below 20, right? Low forward P company. That's another one I could hold and just feel comfortable with. They always stay profitable year in and year out, and incredibly profitable, especially if you compare it versus market cap. The balance sheet's not the best, but it's also not the worst. They actually have a massive cash flow. Last time I checked, it was many hundreds of millions of dollars of cash on the balance sheet. So I like it. I really like it. Not the most exciting stock, certainly, but it is a good company nonetheless. Honest, I really like Honest here. I think we exit this year $5 plus regardless of what happens in the stock market, but we'll see. I'm not going to place any short-term bets on Honest. Obviously I have my long-term position. I'm interested in buying more shares of Honest, especially anything under 3. But anything under 5, I look is a great deal for Honest. Celsius Holdings, 42. Give me more. Celsius is incredible company. Incredible company. Have you guys seen the charts on Celsius? Oh my gosh. Get ready to go off the charts with Celsius here. It's gorgeous. Oh yes. Oh yes indeed. Look at that. Obviously, the Alani acquisition has been huge for them. Rockstar's going to add a little bit as well, and then it looks like Celsius is going to get back to nice growth for their brand. So, yeah. Earnings per share is going to be a massive bounce back over the next year for earnings per share as well. Yeah, I mean, Celsius, I like it a lot here. HIMS is pretty interesting still. I'm still not just fully sold on HIMS yet. Like, I'm getting there, but I'm not fully sold. And listen, Elf Beauty, talk about a buy. Anything under $100 for Elf is a steal deal for that stock. Steal deal. Anything under 100. Bottom line with that. Even under 150, it's still a buy, but anything under 100, steal deal. Let's react to some videos.
We are trading. We've been in this range for a bit now. Dow down almost 400 points. It's less than 1%. NASDAQ and the S&P are both lower as well. As crude oil makes a move here, you almost, Josh, have a two-pronged problem for the market. Not only the move in oil, WTI probably doesn't best represent the jitters in the market just because, Brent today topped 119. And then you have the Fed chair who was more hawkish than not and said inflation's not coming down as much as they, quote, hoped. The odds of a Fed rate hike by June are now higher than the chances for a rate cut. That's the backdrop. That's what you need to know. A hawkish Fed and oil that continues to go up, and stocks as a result are uneasy.
I don't often question the wisdom of the market, but I think in this case, that's crazy. The Fed knows damn well there's nothing it could do with interest rates that would change the price of gasoline at the pump.
Josh Brown, thank you so much. It's so refreshing that somebody said what I've been talking about on the channel for like the last several weeks now at this point in time. Oh my gosh, thank you. Thank you. Thank you. Oh my goodness. Yes.
It's almost an absurd proposition. So I don't believe that to be the case. I understand why the market believes that, just looking at what oil is doing to the inflation numbers, what high gasoline prices are doing. But the knock-on effect to the consumer is actually disinflationary, more so than it is inflationary. It is absolutely causing people to think twice about spending, and I think we're seeing that sentiment everywhere we look. So I don't believe it. The bigger issue for me is the state of the financials. They look absolutely horrible. The 2-year is up the most on the curve right now.
Sure. 385 was what it hit earlier today. We can look at it as Josh is talking. I didn't mean to interrupt, but just to give context to that, yields are definitely up, especially on the short end, on the back of what Powell had to say yesterday and where the Fed seems to be positioning.
Yeah, no, Judge, it's the right interruption because that's really the most important thing. This is the highest we've seen the 2-year since August of 2025. And in the meanwhile, it almost feels like there's nowhere to hide the last couple of days. Gold just broke down below its 50-day moving average. Metals and mining on the whole are the stocks themselves are negative. The materials are down 2%. We've lost the home builders because mortgage rates are not coming down at the rate that we had hoped earlier this year. And now you've got 26% of the S&P 500 below the 50-day, which is the lowest reading since Liberation Day almost a year ago. That is a 2 standard deviation below the mean, and it's problematic. 52-week lows on the NYSE are now at 5%. That's the highest since November. So it's a risk-off tape, and we've lost a lot of the areas that we were using as sort of like all right, here's a little bit of a hedge, or here's a little bit of a non-correlated asset. People are just right now looking at a lot of these developments, looking at the bond market, looking at oil, and just saying, you know what? I don't need to figure out the next thing I want to invest in right away. Let me move some cash to the sidelines.
Jan, it's the stats continue along the lines of what Josh was talking about. This was as of yesterday. Less than 30% of the S&P stocks are above their 50-day. It's the lowest since April of 25. So go back to Liberation Day, to when the market really got upset, and you had a number of stocks below their 50 days. So we're not looking great under the surface. Metals, gold is worst week since 83. And Jonathan Krinsky at BTIG says, buckle up, that the 200-day moving average of the S&P 500, which is 66.15, looks unlikely to hold. We're below it now, okay? So it's unlikely to hold. He thinks a move towards 6,000 has a decent probability. That barring a close back above 6,900, so that's, a few hundred points higher from here, that the bears maintain the upper hand.
Well, I think one of the reasons that we saw this broadening out, particularly since August of last year, was this expectation of accelerating economic momentum. Part of that explanation was a continued accommodative monetary environment, not just here, but also outside of the United States as well. Josh already pointed to disinflationary trends. And then there was also this expectation.
Hold your horses one moment here, ladies and gentlemen. Listen. Be very crystal clear about this. As somebody that's been in the market 17 years, watched CNBC for 17 years. Okay, listen. When we're going through a time period and the market's downtrending, everybody starts feeling worse about the economy. That goes on in these shows. The stock market really dictates how people feel about the economy. I even sometimes feel it. If the stock market's going up, I start looking through like rose-colored glasses. Like, the economy's really good. If the stock market's going down, I start looking at it and I'm like, looks like the economy's bad out here. And so understand when you're in the stock market and you're playing the stock market game, if the stock market's going down, you're naturally just going to have a lot more concerns about the economy. And when the stock market's going up, all of a sudden everybody's feeling great. Let the Dow go back up to all-time highs. It's down about 4,000 points or so from all-time highs. Let it go back up 4,000 points and watch it. Everybody's going to start saying, economy's strong. Looks like the economy's good. There's not all some people aren't going to worry about the economy anymore. It's when the stock market starts going down. It's hilarious. And as I'm telling you, as somebody's been in the game 17 plus years now, it's always been the way it is. And it's the way it is, man.
Improving margins due to the implementation of AI. At this point, several layers of that value proposition, if you will, in terms of the momentum of the equity market have been upset. We're not looking at potentially as much accommodation. We're actually looking at potentially more restrictive. We're already seeing some tightening financial conditions, not just from yields, Scott, but from some of the carryover from what's happening in the private credit market. And then you look at the state of where to hide. I mean, with energy being the only sector that's positive this month, most investors are underexposed to the energy market based on its percentage in the S&P 500. And so where do you hide in this environment? You still have this bit of this hangover from the AI disintermediation obsolescence argument. Now you get potential challenges in the Middle East. And if you're sitting in cash, cash yields look, kind of attractive right now, especially if they're not going to be moving lower. And so if you're wanting to put money into a market that perhaps is reflecting more attractive valuations, you're feeling like maybe you have a little bit of time to do that, given where yields are.
You got a choice of, Malcolm, wherever you want to go, because we've covered sort of everything that's moving around. Dubravko Lakos over at JP Morgan's cut his S&P target to 7,200 from 75, just to, represent where sort of the risk factors are now and where sentiment seems to be, and that the market in his mind is continuing to price in a short term, a quick end to what's happening in the Middle East. And he's not so sure, nor are, other investors too. How do you see it?
I think those two things run together. I think you made a really good point about the 50-day moving average when you harken back to Liberation Day, but the 200-day moving average, which we've now fallen below, we haven't seen us breach that level since May of 2025, which was sort of the backswing from Liberation Day. And so I think that's meaningful here too, because it shows just how much pessimism has just kind of come into the markets all of a sudden. I think it's also a little bit disappointing to the point that Shan's making about where we are, because earnings were actually really strong in the first quarter. We blew out expectations by a wide margin for the majority of stocks that reported. And I think that's disappointing moving into a market that now is being uprooted by oil shock concerns. We're being uprooted by now private credit concerns that already existed. Now there's even real conversation happening, whether Josh likes it or not, about interest rate moves upward instead of downward. Like, that's all meaningful for a market that was coming into the year celebrating how strong things look from a fundamental perspective.
Hey, I mean, the kind of market we're in right now, look at Micron. You need you a better example than Micron today, which had a blowout quarter. There's no other way to say it. Now, the chart's been a blowout for the last several months, so maybe that has more to do with this than anything else. But they had a blowout quarter and the stock is down. So in this kind of tape,
similar to Nvidia a couple of weeks back.
And this is in a huge high flyer, and the stock's down 5% on what I said was a blowout quarter by any estimation.
Yeah. So I alluded to the financials for a reason. I think that structurally they were extremely important to the bull market that we experienced in 2025. And I think from a sentiment standpoint, we can't afford to lose them to the extent that we are. They're not as big as tech. They're not as big as consumer discretionary. But when investors think about the lack of follow through from the financials, it just makes them second guess all of the other rallies that we have been seeing. And now that lagging performance has actually turned into detracting performance. These stocks are very important. Capital One Financial is down 26% year to date. That very rarely happens outside a much bigger disturbance in the financial system. Wells Fargo's in a 20% bear market, Prudential not far behind. The breadth of poor performance in the financials is 100% creating a psychology problem amongst the bulls. Out of 70 financial stocks that are in the S&P 500, literally only 5 of them are up this year. Only 5. And they're not necessarily the 5 that you want to see. CME and CBOE, which are 2 companies that thrive on market volatility. Interactive Brokers up 5%. Then you've got CB and Travelers, and that's it. All of the other financials are in the red, and many of them substantially so. How do we get a bull market going with these companies so deep in the hole?
Okay, listen, JB. I love it. I mean, he brought out so many amazing points. And listen, it's very fair. Like, it's hard for the market to get bowled up and feel bullish when you have financials so weak. You really have to have financials moving and grooving to give that full, bullish experience in the market. Let's call that Micron.
They've been on fire, up more than 320% from a year ago. Stocks pulling back minor today, despite results that handily beat Wall Street estimates, and the pullback should not be a determinant of your thinking about the situation. That's why I'm so glad to have Sanjay Mehrotra, who's Micron CEO, first joined CBC. Sanjay, thank you for being such a good teacher, and congratulations, because you basically taught us that we are so far, so early, because of what's going on with agentics and AI, that we shouldn't make a judgment that this time we are about to roll over. It's too early to think like that.
First of all, Jim, great to be back on your show. You're absolutely correct. AI is in very early innings. You just saw at GTC how much advances are being made in AI. And memory is a strategic asset. You need more memory, you need higher performance memory in order for AI to be able to deliver its full capabilities. This is inference inflection. As inference broadens, it will scale up the need for tokens. Those tokens need to be fast. And guess what? You need more memory, you need fast memory in order to deliver the full potential of memory. And memory today is very tight supply, and supply cannot be brought up that easily. And you are seeing that in our results. You are seeing the value of memory reflected in our strong financial performance in Q2. By the way, our Q2 was a $10 billion increase from our fiscal Q1. Our fiscal Q3 guidance is another $10 billion increase, nearly $10 billion increase in revenue. And that puts us at midpoint of our guidance at about $33.5 billion. If you look at S&P 500 tech companies, Micron is among the top 10. Micron is the invisible layer powering AI today, and that's reflecting in our strong performance and strong outlook as well.
Well, we should distinguish the Micron that is high bandwidth memory, Micron that is NAND, Micron that is DRAM. And it's clear, Sanjay, that you're struggling yourself with a limited number of dollars versus the amount of money you have to spend to be able to meet the demand. How are you prioritizing? Because holy cow, what you choose to prioritize is going to impact what everybody else in the world is doing.
Jim, memory supply is tight across the end market segments. Of course, HBM is in tight supply, and non-HBM DRAM is in tight supply, along with NAND. They're all in tight supply. We have tightness across all our end market segments. We are only able to supply for our key customers in the midterm about 50% to 2/3 of their requirements. We are continuing to work hard to bring up supply, but bringing up supply is a very long lead item because DRAM needs new capacity. New capacity takes new construction. Construction is long lead time item. So earliest that we see in the industry meaningful ramp starting to happen, and it will gradually happen over time, is starting in 2028 timeframe. So I do not see supply catching up to demand for considerable period of time here. Of course, this is a period of heavy allocation. Micron has a very strong technology and product portfolio, and we continue to optimize the mix of our business. Today, non-HBM DRAM has actually higher profitability than HBM. NAND has strong profitability as well. So we are managing the mix of the business, keeping in mind long-term considerations, and absolutely data center is the biggest growth driver. We are well positioned with our product portfolio, including HBM, to address these demand trends.
So the big risk with MU, obviously we know the numbers great. So from the reward perspective, like we all know that story. The numbers are extraordinary for this company, and it doesn't trade at a rich PE, forward PE, any of that stuff, right? The risk for MU, big risk, is a scenario where you get a lot of economic weakness, right? And let's say Meta and Amazon and all these companies that are spending a fortune, Google, go through the whole list of them, start to miss revenue estimates as the year goes on. Because let's say hypothetically it's a big recession that happens, right? Or a decent sized recession. Suddenly those companies are then going to cut CapEx in 27 because their stocks will go down significantly more than they've already gone down, right? At a time period when revenue is not hitting. And then you're stuck in a pickle, and those companies obviously have to start to cut back spend significantly for 27, 28, right? Who's that going to hit the most out of anybody? Two companies. One's Nvidia, and the other's Micron, MU. And the reason being is Micron's margins were something like 80% here. Like, it's just ridiculous. Like, those are not sustainable. Those are not realistic numbers, okay? For the long term. For the short term, as in the next year, maybe 2 years, that's, sure. But long term, anybody who knows about this industry knows that's just silliness, okay? And so if you have a pullback, then all of a sudden their pricing power goes away, and all of a sudden, next thing you know, what they can get for, their memory chips go down substantially, and all of a sudden you see that stock go from $450 down to $100, down to $70. I mean, it's not like it's a little fall, like, stock goes down 10, 20%. No, stock goes down like 70%. Nvidia, same exact thing. If Nvidia all of a sudden starts getting a cycle where revenues start going down and their margins start going down because customers aren't ordering as much, and all it takes is some major economic weakness. And that's like these companies like Amazon, Meta, all these companies have nice revenue growth. That's why they're able to get away with their stocks not crashing and still spending a fortune. If the revenue starts missing as the year goes on, because let's say the economy is just not as good, if that were to happen, dude, they're cutting CapEx in 27 and 28 by pretty substantial numbers. And that's night-night for Nvidia, and that's night-night for MU. And so just something to keep in mind. We all know the reward potential, and we all know those companies numbers are insane. But if I think about some companies that would be hurt the most by, weakness in the economy, that's where it comes from, because those companies, it's not just about their revenues going down, their margins would collapse. So they would no longer have customers banging on their door saying, please give me more memory. Please give me more chips, Nvidia. All of a sudden, they're like, no, actually, we're good. And that's when the major pricing, it'd be bad. So anyways, just something to keep in mind there. That's not like it's guaranteed to happen, because the economy might be fine this year and might merge out, and spending can still be strong from these companies. But I'm just saying, I'm laying it out for you guys. If things go south there, night-night. Thanks so much for being here. Thanks for being subscribed to the channel. Additionally, how to manage a portfolio at every stage of wealth. That will be a free workshop for you guys. I filmed that this weekend for you. 35-minute video. That will be pinned comment down there. Dow Jones Industrial Average down over 4,000 points from the highs it hit not that long ago, now down over 8% now at this point in time. We're looking at Coinbase stock here, down 51% from its highs. MicroStrategy down 70% from its highs. SoFi down about 47% from its highs. The Hood, back to the Hood, down 50% from its highs. Little Dingo is down 81% from its highs. That is Duolingo. Hims is down 64% from its highs. Tesla's only down 20% from its highs. Looking at Palantir stock here, Palantir is down 26% from its highs. Meta Platforms, the beast. Even big techs have been getting hit. This stock is down 22% from its highs. Oracle stock down 53% from its all-time high. Amazon stock down 17% from its highs. Nvidia, the most amazing numbers in the world. What an incredible company. And yet stock's down 13% from its highs. Shopify's down 31% from its highs. One of the most underrated great companies in the world is Shopify. AMD, look it, they're going to have just unbelievable growth rates moving forward, but that stock still troubled, down 25% from its highs. Adobe down 60% from its highs. Salesforce down 47% from its highs. Here we are, folks, once again in a moment in the stock market where they're saying don't buy stocks. Don't buy stocks in 2026, right? This time is different. We got a lot of scariness out there, right? And I have some opinions on this subject. 3 core subjects we're going to get into in this video here today. First one up here is I'm going to make a very strong case why you need to be buying stocks heavy in 2026. I'm also going to share some shocking information in this video about what I'm doing with my money moving forward in terms of the stock market. That's going to be, I think, pretty eye-opening for a lot of individuals and kind of understanding what I'm up to, why I'm doing it, okay? From there, second subject we're going to get into here today is I'm going to address the top comment I had on yesterday's video. I think it's very important. Third subject up here, Micron. That stock is moving down and their earnings were shockingly great. Unbelievable earnings, okay? Why? What's going on there is an opportunity, those sorts of things, okay? I appreciate you for joining me for today's video. There's one thing and there's one thing only I need from you guys here today. If you could make my day, I would be very happy. Just smash the like button. Just hit that like button. Smash it. Hit it lightly. Hit it like a fairy. Do whatever you got to do to make it glow. Thank you very much. Additionally, make sure you're subscribed here to the channel. You can see more of my videos in the future. If you're subscribed, we are now at over 920,000 subscribers. If you haven't subscribed, what the heck are you doing? Join us, okay? Alrighty, ladies and gentlemen, listen. I wanted to start today's video looking at interest rates in thinking about things like, what if you were to buy a home right now? What if you're going to take on credit card debt? What about a used car? Those sorts of things, okay? The 30-year mortgage rate right now is 6.36%. Credit card interest rates are pretty close to 20% right now. The average interest on a used car loan right now is right around 11%. Average. Brutal, right? Right now, it does not make sense to buy a new home, a new car, to take out a bunch of credit card debt, any of that stuff. And I mean, credit card debt basically never makes sense to do that. That's craziness, right? You can use credit cards to get points as long as you pay it off right away, but never pay interest on a credit card. That's insanity, right? Right now, it makes sense to put money into stocks in the short term, not to go buy a new car unless you absolutely have to, right? If you absolutely need to buy a house right now, you can go buy a house, right? But at the end of the day, it makes the most sense short term, meaning likely the remainder of this year, so let's say the next 9 months, to be putting money into stocks and not go buy a new $40,000, $50,000 used car, right? Like, it's just not a good time to be doing something like that. If we look at me and my purchases I've made over the last few years that are kind of big ticket things, I've moved away from taking out loans really on like cars. Cars, I used to always take out loans. I would never buy, the only car I ever bought cash was like my second car ever. It was a Hyundai Elantra. I bought it for $3,300 from somebody. Other than that, I've always been the type to get a car loan, because you know why? I'm thinking about it in terms of the rate a return I can get in the stock market versus what I would take out car loans for. Like car loans, I would get them at 2, 3, 4%, very low numbers. I've moved away from taking out car loans. The Ferrari I bought, back at the end of 2024, cash. The Model X I bought, cash. That one was the end of last year in 2025. And even my new house I'm buying, right? That I put 30% down for. All the projects that are going on in that house, all buying everything cash. There's no loans on the backyard projects or anything like that. All the furniture, which is going to be insanely expensive, all cash. Not taking out loans for any of that. I've really started to move away from like taking out loans on things. And I think we all need to start doing that until, let's just be honest, interest rates are a lot lower than where they're at right now. You do not want to sign your name. I mean, if the average is that, some people are going to have to sign at 14, 15% rates, maybe 16 or 17% rates on a used car loan. Come on, man. We can't be doing that stuff. So right now it makes the most sense possible to be putting your money into stocks. Now, if we can continue to get more weakness in the real estate market, right, and mortgage rates come down simultaneously, eventually, it can make sense for a lot of people to buy homes. But right now, I think the only homes that are really make sense to buy for the most part, from what I'm seeing, is really the high end of the market. High end of the market's pretty weak right now, but the high end of the market, a lot of people can come buy those homes cash. So do keep that in mind. Look at this here. This is a fear and greed index. We're now in extreme fear for the stock market. This is certainly not the craziest reading I've ever seen, but we are in extreme fear for the market. The previous close, we were also in extreme fear, so we're now even more in extreme fear, right? A week ago, we were also in extreme fear, but not nearly. So basically, we have a trend of the fear and greed index, which kind of takes like 7 very important factors into account to kind of give you this reading here. We're moving further and further into extreme fear is basically the moral of the story. If you look at a month ago, we were in fear for the stock market. It was at a 41. So basically we have this trend of the market moving more and more further into extreme fear. That's always a great time to buy. I've never seen it where you've had a trend where you moved further and further into extreme fear and it wasn't a great buying opportunity. To catch the absolute low, difficult. But the moral of the story is, ladies and gentlemen, listen, you need to be buying stocks right now. You need to be buying stocks, and you need to not stop buying stocks. You need to be buying stocks next week, next month, the month after. This is like an aggressive kind of time to be buying, right? Now, look at AI investor sentiment. We have a clear trend toward bearishness, right? So the historical average is 31% of investors that do this survey, and basically the survey is, are you bullish on the market the next 6 months or bearish, right? Or neutral. And clear as day, like we're, significantly above where you're supposed to be at for historical average for people feeling bearish about the stock market the next 6 months. The latest reading came in at 46.4%. Versus usually 31% of people are bearish on the market the next 6 months. Now, I use this as a contrarian kind of way of knowing if you're buying stocks at good valuations or an attractive time to be a buyer in the market, right? And usually the further and further this gets into bearishness, just another one of those things. Every time I see this go very, very bearish, it always ends up being a great time to be a buyer of stocks. And you look back a few years later, and like, oh my gosh, remember when everybody was bearish and like it was a great time to buy. So when you see AI investor sentiment continue to go worse and worse bearish, and you see fear and greed index continue to go further and further bearish, you need to be buying, right? Look at this. I typed in Google Trends. If you guys never look at Google Trends, I think it can be valuable. How to buy stocks, right? I think I put how to buy stocks, which is probably a popular term that usually when people are looking to buy stocks, they're going to be searching something like that, right? And so I did this trend kind of over the past 6 months roughly, and that has definitely dropped off a cliff, right? A lot less people saying how to buy stocks. Why? Well, the stock market's very weak right now. Additionally, right? Usually people kind of start looking into stocks when they hear from their friend, their family member. Oh, I just made another $10,000 in the market. I just made another $5,000 in the market. Look at this. I just doubled my money on this stock, right? And you hear a lot of those stories, and then other people start looking and like, oh, my buddy, who's not even as smart as me, he just made himself $14,000 in the past month on his stock market portfolio. I should probably look into that, right? And these stories get talked about. You also see it on social media, and more people start looking into like, how do I buy stocks? Like, how do I do this? Like this is interesting, right? I want to start making this money everybody else is making. And that term has obviously fallen off quite significantly. So we're in a time period where just not as many people are kind of looking to buy stocks right now, right? Now, this can also spike up when you're in a crash. So do keep that in mind. So like let's say the stock market, let's say the S&P 500 went down 20% over the next months. Probably not happening, but let's say it happened, right? This term would spike huge. And that doesn't mean it was a bad time to buy in the market. That just means like because the crash was so dramatic and everybody in the media was talking about it, it makes people say, oh, let me look into that, right? Now, look at this. I typed in this term, pretty popular term, stocks to buy over the past 3 months. Look at where we're at right now. That's fallen off a cliff certainly from the excitement there was, in the past. And if you look at a 6 month, you see even a more dramatic move. Now, I also typed in this term, stocks to buy over the past 5 years, and look at this. right? Obviously, you can see clear trend of major downward move there. But gosh, man, this hurts me to see this. Look at how low this term got at the end of 2022. I mean, think about that. People missed 1,000% plus gain in Nvidia. They missed Meta at $88. They missed Palantir at $6. They missed Shopify at $25 and countless other great stocks and great opportunities. And people just took like a buyer strike, basically from the second half of 2022 into the first half, or no, basically into the beginning of 2024. And what a disappointment, man. Because people just missed incredible opportunities in the stock market. Like just ridiculous steal deals all over the place. And why was this? I'll tell you exactly why this happened. It happened for a few reasons. One, inflation. Inflation sliced and diced the consumer out there. So a lot of people didn't have a lot of extra money at that particular time to invest. So that definitely played a part. It wasn't the biggest part, but it played a part. Two, coming off of the hype and excitement at the end of 2020 and into 2021, and then going through a brutal bear market where the NASDAQ fell 37% peak to trough, that damaged a lot of the psychology of the market, and a lot of people just gave up. They threw in the towel. They said, the hell with this. I'm not doing this anymore. This stock market thing sucks, right? That happens. Don't let that happen to you guys. Oh, gosh. Every time it happens, you get into a correction, you get into a bear market, and people throw in the towel. Say, I'm done with this. I'm out. And they either never come back, so they just miss like incredible life-changing money over the years, or what happens is they leave for a while, and then guess what? They come back when everybody's already made a ton of money again. You got a raging bull market because they like, oh, everybody's making so much money now. It's safe to invest again. They end up getting in near all-time highs and end up getting screwed again, right? And so you got to stay in for the long term. Don't throw in the towel in this game. I'll tell you guys about a good friend of mine. Good friend of mine. I tell this story sometimes. You know, this man, he got screwed in the housing bubble. Housing bubble in Vegas. He bought a house at a really bad time, right before the housing crash, and he decided to never return to the real estate market. The man's, just rented all these years because he refused to buy a house again. And gosh, he could have made so much money if he'd been buying homes over these years and like even buying real estate investment properties in Vegas. Like, I mean, look at how much things have appreciated over the past 15 years in Las Vegas. I mean, it's incredible, right? So with stocks and with real estate, can you buy at a bad time and get screwed? Sure, that can happen. But never, ever leave the market. Stay in for the long term, because if you stay in for the long term, even if you bought at the worst time imaginable, you're still going to get some great deals over future months and years to buy at prices that are just silly. You could have bought in the tech bubble when the NASDAQ was 4,000. That was close to peak. About 2 years later, roughly, the NASDAQ was at 1,000. Now, you could have thrown in the towel and said, oh my gosh, like I'm never returning the stock market. I bought the NASDAQ at 4,000, now it's at 1,000. Imagine if you just stayed buying over those months and over those years. And like the NASDAQ is what, 20,000 today? Something like that? Think about all the stocks that are great companies in that. Amazon's probably returned 100,000% plus. You could have just bought Amazon stock. We're not even talking Apple and all the other great ones over the years. Just Amazon, you would have, I mean, life-changing money. You have so much money, you don't even know what to do with it. You're like trying to figure out, should I buy a new helicopter or should I buy a new yacht? Like, it's just ridiculous. But people throw in the towel when you're in a correction or in a crash. They leave the market. Worst decision. Worst financial decision you can ever make. Put yourself in a position, you got more income than expenses, you can continuously invest in the market. And let the game play out, man. Don't leave the market. Oh, by the way, another reason a lot of people left the market during this time, I'm going to be completely honest with you guys, because I saw the comments. A lot of people didn't want to buy under Biden. They thought, Biden's president. He doesn't know what he's doing. We don't believe in him, so we're not buying stocks, right? You can play these games, man. You can play these games, but you just miss out on so much money, right? I posted this on my X page here today. You can follow me on X. That will be linked in the description area down there if you want to follow me on X. My X has been popping. But I posted 16 popular stocks down huge from all-time highs, right? And think about it. These stocks down huge, people were piling into these stocks last year. And why were people piling in? I'll tell you exactly why they were piling in. T-Man optimism. Trump optimism. A lot of people very excited. Trump's the president again. Stock market's going to go crazy. Bitcoin's going to go crazy. Everything's going to go crazy. We're going to make so much money, right? And, playing politics, you're going to learn a very painful lesson. You want to play politics in the stock market, you're going to learn a very, very painful lesson. Do not buy stocks because your guy is in office. Do not hold out on not buying stocks because your guy's not in office. It's ridiculous. That has cost people a fortune over time. I don't care who the president is. I don't care if you love him, you hate him, you buy stocks. I got in the market, Obama was president, and I bought stocks. There was a pretty close next election. No, when I bought my first stock, technically George Bush was still president, okay? Then Obama was president. Then it was a close election between Mitt Romney and Obama, right? Pretty close election, relatively speaking. Guess what? If Romney won, guess what I was going to do? Buy stocks. And if Obama won, guess what I was going to do? Buy stocks. And I did it. And then Trump became president. A lot of people scared. Oh my gosh, Trump's president. I don't know about this, right? Guess what I did? I bought stocks. Then Biden became president. Guess what I did? I bought stocks. Now Trump's president again. Guess what I'm going to do? Buy stocks again. Next election, who's going to be president? J.D. Vance, Gavin Newsom, who knows? Who cares? You buy stocks. Don't play politics unless you want to cost yourself a fortune over time. Don't play stupid games. You want to play stupid games, you win stupid prizes, and the prizes are not good at this casino, okay? Don't do it. Don't do it. Do not let your politics decide whether you invest in the market or not, and whether you feel good to buy stocks or not. Yeah, I'll say it again, and yet people will make these dumb decisions. And please try to talk some sense into people around you. When they're, on this like buyer strike, they don't want to buy stocks because this person's president, that person's president, please try to talk some sense into people. And if you can't do it and you can't get through to them and they're too far gone, they're too far gone. It is what it is. But it's just ridiculous, man. Just ridiculous. Now, you want more evidence on why it's a great time to be buying stocks? Well, let me present you some more evidence here. The VIX. The VIX has been elevating significantly. If I recall, I pulled up year to date on the VIX. The VIX is up 68% year to date. Okay, we got an elevating VIX here. You got to be buying stocks over the next 6 to 9 months heavy. Whenever you see the VIX popping and remaining elevated, it's always a great time to be a buyer of stocks. The higher the VIX goes, understand the more of a great buying opportunity you're usually getting in the market. So if now we go from where the VIX is at 25, let's say we keep moving up here. Next thing you know, the VIX is 35, 45. Just understand, you're getting great deals on stocks. And I've never seen it in my life, which, my life's really long. I studied before I was in the stock market, but I've been in the stock market, 17, 18 years now. I've never seen it where the VIX was popping massively and kept elevating, and it wasn't a great buying opportunity. It always is. So just understand that, ladies and gentlemen, okay? Put to call ratio here. Look at the put to call ratio, 0.91. So keep in mind, there should always be a lot more people buying call options versus put options, because guess where the market usually goes over time? Up, up, up. Most years, the stock market goes up. Most months, the stock market goes up, right? But we're at a moment here where people are loading up on put options, right? They're loading up on put options. The closer it gets to 1, the more you need to buy heavy. And if you see it go over 1, especially for any significant amount of time, you got to be loading the boat on stocks. Usually people are late to play this game. They start buying puts at a bad time when they should have been buying puts. Like if you wanted to buy protection on your portfolio and buy put options because you thought the market might go down, you should have been doing that a month ago, 2 months ago. Not now. People are usually late to the game. They'll keep loading puts. And next thing you know, market flips the other way, and next thing you know, their put options are expiring, worthless all over the place, right? You want more evidence? I can't mention the word, okay, because I mentioned the word in a video the other day, and then next thing you know, I got age restricted on the video. So we're going to call it Rod Wave, okay? There's uncertainty regarding Rod Wave right now. We don't know what's going to happen in that situation. We don't know if that's going to go another few weeks, another few months. Experts are talking about this is going to be a much longer situation than what was talked about here. But here's the thing, okay, in regards to this Rod Wave situation. Do not automatically assume this is going to go on forever. So even though the experts are now talking about this is going to be months long process or this could take years, which maybe it is, don't automatically assume that's the case. Remember what happened Liberation Day last year with the whole tariff drama, right? Like, that people thought was going to be devastating, and next thing you know, we saw this happen, and all of a sudden it was like, oh, this isn't as big a deal, and this is getting removed, and this is getting removed, and okay, this caveat here. And so just understand, like, now people are talking about this is going to be a long run thing. Who knows? Maybe it does wrap up in the next few weeks. I don't know. The moral of the story is there's a lot of uncertainty around Rod Wave right now. And when there's uncertainty around a situation like this, a geopolitical situation, you usually have to be buying stocks during that particular time. We have more uncertainty around Jerome Powell. Jerome Powell's talking about he's going to stay on as at the Fed until, you know, the whole investigation's over and stuff like that. So now people are up in the air and they don't know what is going to happen here regarding Jerome Powell. Does this mean the Fed is going to remain more hawkish than people had previously thought? That's a real talk right now, right? And so this is a debate. Now people are wondering how many times the Fed actually going to cut. Are they going to cut, right? All these sorts of thought processes here. And I understand people have an opinion on Jerome Powell, right? A lot of the people's opinion is just because T-Man says he's bad guy, so a lot of people don't even think, and they're just like, oh, T-Man says he's bad guy, right? It's crazy. Like, I can't believe people can be brainwashed by politicians the way they are, but anyways, that's a subject for another day, right? Like, it's wild. I hate politics. Did I ever tell you that? If you've been watching my channel, you know that, right? Hate it. So, Jerome Powell, I don't like him either. I think he made massive mistakes. He pumped way too much money into the economy when he should have been laying off. He let inflation run wild at a ridiculous rate, right? I think he's keeping rates too high for too long. The fact that, you know, he's keeping rates up here right now with CPI where it is, listen, what's the Fed going to do? Like, okay, so you keep rates up high and have the consumer get sliced and diced by oil price being high? If the Fed lower rates right now, that's not going to, or up rates, that's not going to change oil price massively. Oil prices, because of what's going on with the Rod Wave situation, that has nothing to do with like, oh, the Fed got to lower, right? So they're just killing the economy multiple ways. It's like, okay, oil's super high, so that's going to feed into a bunch of stuff. But then also we're going to keep rates high, so then you guys can't take out loans for anything, you can't buy anything. So let's kill the economy while also having you pay super. How about if you lose your job and then you have to pay super high price at the gas pump too? Like, it's just, this is crazy, right? But the moral of the story is I do not think Jerome Powell makes decisions based upon, you know, I think he and the Fed in general make the decisions they think is best regardless of political pressure and all those sorts of things, right? That doesn't mean they make the right decisions, but I don't think they're going to be like jaded and like, oh, we're going to do this because of blah, blah. I just don't see that, right? But the moral of the story is it's more uncertainty that's out there, right? Now, what am I personally doing? I'm making a pretty big move here. Pretty dang big. Listen, public account, for instance, if we go back to the end of 2025, I was putting in basically $500 a week to that portfolio. Well, just recently here, as in last week was kind of the first week it started it, but I'm bumping the public account buys to $3,000 a week. $3,000 a week. Now remember, I have significant cash load because, you know, I just looked at stocks last year and, you know, I did some buying here and there of opportunistic stocks, but it wasn't like we got, you know, we're getting great pricing on stocks. Now we're in a situation we're starting to get very attractive pricing on stocks, and a lot of stocks too. Like there's at least, I would say, 10 or 15 stocks I want to buy right now. If we go back, you know, into Q3, Q4 last year, I don't think there was. There was a few, but I mean, and honestly, there's 10 to 15 stocks that I want to buy bad right now, but there's a lot more stocks than that are great buys right now, right? Now, additionally, on top of this, I'm upping my private portfolio buys as well. So that shows how much conviction I have in kind of, you know, wanting to take advantage of deals out there in the market over the next, we can call it 6 to 9 months. And as long as this market remains very uncertain, downtrends or stays stagnant in a kangaroo mode, right, I'm going to be buying heavy. So that's across all my different portfolios. The only one I'm not upping for the most part is just the, the Patreon portfolio, because that one I'm supposed to just do $250 a week. So I'm going to keep that one the same. But yeah, up in the public account buys big time, and up in my private portfolios buys big time as well. So, and if we can get that VIX to really pop huge to a 40, 50 level, then I'll come in with some strategic, like, big boy buys too, where I'll put in $30,000 in a day, $50,000 in a day, or something like that, right? Ladies and gentlemen, before we get rolling here on the rest of the video, my private group, that will be the pinned comment down there if you want access to all my course curriculums, access to my private Discord chat, exclusive weekly videos, access to 1000xstocks.com, all that good stuff. You know, this is a time period when the market gets shaky like this, demand definitely goes much lower for the private group, right? Much lower than last year. Last year, demand for the private group was ridiculous. This year, it's a lot lower. And it's always fascinating to me because I'm like, now we're getting all these great deals. This is when you got to be taking investing serious. Like, this is when you should be in the course curriculums and doing all this stuff. But, you know, people decide they want to, you know, join something like that when, you know, market's at all-time highs. And then, you know, when you're getting all this great pricing on stocks, you know, people are like, I'm not as enthusiastic about joining. It's always wild to me, man. Because I'm like, now's the time. You need to be in the course curriculums. You need to be taking this stuff serious. Like, whenever you're getting corrections, crashes in the market, that's when you got to get involved in a serious way, right? But anyways, just wait. You know, next thing you know, market turns, AMD goes on a big run, blah, blah, blah. Also, demand's going to go crazy for the private group again. I'll be like, oh, yeah, I remember, you know, when, you know, demand was really low because stocks were down. Like, it's just always fascinating to me, right? Now, I came out with a video yesterday on the Reaction channel. I'm not sure if you guys watch this channel or not. It's called Jeremy Lefebvre Makes Money. 58,000 people gotten to see this video so far since it came out. My stock is under attack. So we spoke about different subjects in that video, but the top comment on the video was this one. It said, Walmart, people will pay a 42 forward P because I offer great visibility on my 6% revenue growth. Nvidia, people will not pay a 22 forward P even though I offer great visibility on my 70% plus revenue growth, right? And I think this is a frustrating thing for people in the market. Very frustrating thing. And I get it, right? Let me say a few things about this. First off, Walmart, I think it is trading way too expensive right now, right? Way too expensive. But it's hard to say what a stock should. Look at Tesla, for instance, right? Tesla numbers factually have been awful the last several years. Trash. That's not a debate. That's just a fact. It's been awful at Tesla for the last several years, right? And yet the stock trades at like, you know, just ridiculous P ratio. Does it deserve to be that? Not in my opinion, but the market chooses to do silly things sometimes. So Walmart trading at a 42, you know, P or forward P, I think it's silly, but the market's going to do what it wants to do, right? But the big thing you got to understand is Nvidia, people are viewing this year, next year as good as it gets for Nvidia, right? That's not the view of Walmart. No one's scared that, you know, 2 or 3 years from now, Walmart's margins are going to crash and their revenue is going to crash. People are legitimately scared of that for Nvidia. And I get it. You should be at least somewhat worried about that. Doesn't mean it's going to for sure happen, but you should be, it's a possibility. Does Amazon, Meta, Google, do they want to continue to spend every dollar of free cash flow they possibly have on Nvidia chips 3 years from now, 4 years from now, 5 years from now? I don't know about that. Maybe. But I think there's a strong debate that they're not. And they're going to spend heavy this year, and then they're going to moderate that CapEx spend majorly next year. And then they're going to look at their businesses, and if the numbers aren't massively helping them grow revenues, they're going to cut. And that's going to hit one company harder than any other company in the world, and it's Nvidia. And so understand that's why people are not, the numbers are great. The guidance is great. Jensen's doing everything in his power to get people to buy that stock, and they're just still refusing because there's belief. And I don't think it's false belief. I think it's realistic belief that what's going on this year and next year is as good as it gets for Nvidia, right? Now, that's why I made the prediction last year in regards to Nvidia. I said this stock's going to stay stuck between about 125 and the 200-ish range. When people are feeling very bullish, they're going to bid Nvidia up in a major way. It's going to go to 200-ish range, right? When they're feeling real bearish, it'll go down to about 125, but it's just kind of going to gyrate there. And that's just going to be what it's going to be for a while, right? Until you can get clarity about, you know, multi-year out numbers. And you just don't have that right now. Now, additionally, you took the excitement out of the stock as well when Jensen's given the guidance. There's not much room for like some shock and awe numbers at this point in time. Now, additionally, Nvidia's had the whole game on lock the last several years. That's not realistic anymore. AMD is about to start growing. Like, they're not going to magically just get these growth rates from anywhere. They're going to be eating market share here, right? Nvidia's revenue next quarter is supposed to go up 32%, 36% the quarter after, 27%, 40%, 43%, 46%, 45%. Keep in mind, I think a lot of these numbers are low. I think analysts are way low on a lot of their numbers. But the moral of the story is here, AMD is not just going to accidentally get all that revenue growth, right? They're not just going to accidentally start doing $15 to $20 billion a quarter in revenue, right? And then 25 billion and 30 billion. That's not just that money's going to, there's going to come market share out of Nvidia. And so that's what's going on with Nvidia here. And it just is what it is. Doesn't mean Nvidia is a bad company. It's a great company. They're going to continue to put up great numbers. But if you're wondering, like, why are they not going out there and stampeding and buy Nvidia stock? This is why. And when you got somebody that's a serious competitor like AMD, and these big tech companies are going to spend fortunes with AMD over the next several years, what do you do if you're Nvidia? Do you let AMD just take your market share, or do you lower price? Let's say they lower price, right? Well, your margins are going to get killed. Here's why. AMD usually pretty significantly undercuts Nvidia price. So Nvidia would have to come way down on price. It's not a good time to come way down on price. Do you know why? Memory. Memory prices have exploded, which is going to be the next subject we're about to get into in regards to Micron. So if your memory cost is going insane, right, while you have AMD pressure and you're like, should I lower price to compete with AMD? And you also have the pressure from Broadcom with the custom chips. You're stuck in a weird position if you're Nvidia. You're like, we feel like we have the best of the best chips, but do we? Like what if somebody has just something a little less? But guess what? It way undercuts on price. So that sometimes you don't always need the best of the best chips in every situation. There's many situations where you need a great chip, but it doesn't have to be the Bugatti. Doesn't have to be the Formula One car. There's certain situations you want the Formula One car, but that's not always the case. If that was the case, then AMD wouldn't have a business. If that was the case, Broadcom wouldn't have a business, right? But there's many use cases. The more you go down the rabbit hole on, that you don't need. Like, it's a complete waste of capital to have a F1 car if you don't need it to do F1 things, right? If I need to go to the grocery store, like, the minivan will do fine, right? The SUV will do fine. You don't need the F1 car to go down there. It doesn't make sense. Understand? So that's what's going on with Nvidia. And I understand for newer investors to the market, it's very frustrating because you're looking and you're like, why? The numbers are so amazing. They're going to continue to be amazing for at least this year and next year. You got to understand the way deeper things going on here, right? And Wall Street gets it. They understand this. And that's why you're continuing to see that stock with, just not momentum right now. But there will be another bullish cycle in Nvidia. And you'll see the stock move up to 200-ish range. But if you're expecting that stock to go 400, 500, 600, AMD is going to go 400 to 600, but not Nvidia. Okay. Next one up here, at least not anytime soon. Next subject up here, Micron. Down on these unreal earnings. Micron, listen, look at this. A++ grade income statement here. Revenue went from $8 billion to $23 billion. Gross margin went to $17.7 billion from $2.9 billion. Operating income went to $16 billion from $1.7 billion. Net income, almost $14 billion from $1.5 billion. Diluted EPS, $12.07 versus $1.41 the same quarter last year. That's an A++ quarter for Micron. Shockingly great. The guidance was amazing for Micron. One of the biggest memory chip companies in the world. Incredible, right? The numbers are putting up. Now, you look at the stock, it's a tricky one. You're like, what? Look at these growth rates. Look at these numbers. This is insane. And then you look at the 2-year forward P and it's, single digits. And you're like, huh? Forward P, based upon the guidance, they're probably at a forward P right now of like 8 or 7. And not 11 because the guidance was so insane. But this is actually a red flag. I know it's confusing for investors. They're like, wait, I thought a low forward P is good. Sometimes it's good. Sometimes in a cyclical industry like a Micron, it sounds crazy, but it's the truth. And you can go back throughout time. When Micron trades at very rich, very high forward PE, almost always is a great time to buy the stock. When Micron trades at insanely low forward PE, it's usually not a good time to buy the stock. It's like counterintuitive. It's like, how? What? But that's the way this company is, because basically what happens is commoditized industry. And I know people want to try to pitch it as not commoditized anymore. It's a commoditized industry, okay? Several companies you can get the same exact thing from. What happens here is they increase capacity during a time period. Micron themselves are increasing capacity. They're not going to be the only ones because there's so much money to be made here, right? Over the next year or two. So you increase capacity. Then what happens is whatever that memory is going to all of a sudden has a big slowdown cycle, which will likely end up happening, right? And that will happen. That's not like a question, because Amazon's not going to magically go to $400 billion of CapEx in the next 2 years. Like, they can't do it. They're already maxed out. So if they're going to increase, it's very small increases from here. So all of a sudden demand starts going like, oh, demand was insane. Now it's like coming down and being more modest. And that's when you get pricing collapse for memory prices. Think about it. If Nvidia now is going to have to compete with an AMD in a major way, and they have to figure out, do they want a lower price, and they start getting complaints from their customers, their customer base is like, hey, we might not order as much because you know what, some of our products aren't taking off as fast as we thought they were going to take off, so we probably don't need as much in general, and your pricing's kind of crazy, and all of a sudden Nvidia is like, oh shoot, what are we going to do here? Maybe lower price? You think they're going to want to keep paying Micron these prices? No, of course not. They're gonna put pressure on Micron. That's always what the big OEMs do. Apple would do the same thing in the smartphone industry. I used to own a lot of semiconductor companies that did a lot of business with Apple, Cirrus Logic, Skyworks Solutions, companies like that, right? And even Qualcomm back in the day, maybe even a few others, right? And Apple would have certain time periods when their margins would start getting squeezed due to competition from Android. And so Apple would then squeeze their semiconductor companies that go into the iPhone. So all of a sudden, Cirrus Logic would get a squeeze. Skyworks would get a squeeze, and other companies as well. It was not a fun time. Same exact thing happens in the memory chip space. If all of a sudden times get a little harder, like right now, the memory chip companies, right now meaning this year, next year, they can charge whatever they want because Nvidia's having a great time. AMD's growth rates are, obviously going to be blowing up over the next couple of years. So they can get away with it. As soon as you start to see a moderation of CapEx, you can't get away with it anymore. And that's when you get the squeeze. And all of a sudden, SK Hynix, Samsung, Micron, and other memory chip companies, there's a few others out there. All of a sudden, you start feeling the squeeze and pricing lowers, margins lower. And then next thing you know, your revenue starts going down. People are like, what? Revenue was going up like 1 billion%, and now it's going down? What's going on here, right? Micron, I mean, this is silly, because you got a company trading at over $500 billion market cap. Over $500 billion for a memory chip company? Now, Micron deserves to be trading at $100 billion, $200 billion, maybe even $300 billion. But I mean, come on, guys, what are we going to push this to? $1 trillion market cap for a memory chip company? Like, this starts to get silly, right? Like, this is unsustainable. And that's why you see the stock down after hours, because more and more investors are realizing this is not sustainable long term, right? To put this in reference, AMD is like a night and day, is disrespectful to even like try to say Micron's a more innovative or important company than AMD. It's not like, no. Anybody that knows anything about this industry knows like AMD is one of the most important companies in the world, and they will get the value for that over time. AMD trades at a $325 billion market cap. Micron's at a $519 billion market cap. It's not sustainable, right? I'll tell you a story about when I worked at QuikTrip back in the day. When I worked at QuikTrip, there was a story I got told of, and this was kind of around the time gas prices were going crazy in the great financial crisis, and it was massive move down in oil. But anyways, some of the trucks, some of the ones that worked at the truck stop, some of the store managers, they were making more money than their boss's boss. In between that, there was a training manager, and then the next position up was a supervisor. And because of the way the bonus structure was at that particular time, there were store managers making more money than their boss's boss. Does that seem sustainable? No, it's silly, right? And adjustments were made, obviously, right? And so when you got a company like Micron trading at this sort of valuation, just understand this is not sustainable long term. And you could make an argument that this time's different. No, this time's different. That's what they've been saying for the longest time in the memory chip industry. This is not the first big boom cycle. This is just one of a number of boom cycles. And then the bust hurts bad. And so that's why that stock's down after hours. The numbers were an A++. The guidance was insane. I'm sure the conference call is amazing. Everybody knows that. Why do you think the stock went from $80 to 450? Didn't just go there by magic. It did it because people knew the numbers were going to go insane, right? If you're looking to join my private stock group, you're not going to join my private stock group right now. Stocks are down. Let's be honest about that. But if you were brave enough. So ladies and gentlemen, I make a couple posts on my X page here today, this morning. And it was fascinating because in those posts, both of them, I actually referenced SoFi. And I got a bunch of comments from people. Jeremy, have you seen the big short report on SoFi here today? SoFi at this time, the stock was tanking. It was down to $16 range. And I'm like, what is going on here? So I start looking into things. And Muddy Waters, good old Muddy Waters, is short SoFi. And they come out with this big short report. And so I thought at the front of this video, let's go ahead and take a peek at this short report. Let me give you, I think, let's call it a debate on the other side in regards to this and kind of talk about what's realistic and what's not, and what does this mean for SoFi stock moving forward at this point in time, okay? From there, I want to react to this. Nvidia CEO Jensen, he's been the subject of conversation in the last 2 days because of the big conference they've had, and he seems like he's done everything to possibly try to get Nvidia stock going up, and it's still not going up. It's unbelievable, really. Like, it just... everything's so positive, and yet the stock just can't go up. So I thought we'd talk a little bit about Nvidia, what's going on there, and then how it relates to AMD. Sure, there's a lot of AMD shareholders watching this video right now, and I want to talk about what all this means for AMD as well. Now, if you're somebody that's been buying SaaS stocks recently, and you've seen the SaaS apocalypse, and you're like, I think I like some of these stocks. Maybe it's a Salesforce, maybe it's an Adobe, maybe it's a ServiceNow, maybe it's something else, right? I think it's a very important question that Amit got to ask to Jensen today, and listen to how Jensen answers this. And I want to kind of, dissect this for you guys and kind of share my opinions and perspectives here. And then last one up here, Nvidia will be a major beneficiary of the growing inference pie. This is going to be really important, especially if you're an AMD shareholder out there. I appreciate everybody joining me as always. One thing and one thing only I need from you guys. If you could please just smash that like button. That would mean the absolute world to me. I hope you can take 1 second out of your day for all the time I record these videos and just hit that little thumbs up icon. Additionally, I release usually 2 to 3 videos a week on this channel, so make sure you're subscribed, have notifications on, so anytime I drop a video here, you're ready to rock and roll and check it out, okay? Appreciate you for being here. And all that good stuff. Okay, listen, by the way, my X page, if you ever want to follow me on X, I always have it linked in the description area down there today. I'll put it out also as a second pinned comment down there today, right underneath the application if you're looking to apply to join my private stock group. Okay, so it'll be right underneath that. Muddy Waters is short SoFi. Oh, baby, let's go. Muddy Waters is short SoFi. We believe SoFi is a financial engineering treadmill, not a healthy origination business. GE Capital style marks, Enron-esque off-balance sheet structures, and relentless dilution. Listen, you're going to come out with a short report, you better chat GPT, you better Google Gemini what the best way to phrase this is, right? And it almost feels like they did that, like, how can we make this sound the most scary way possible, right? And that's what you got to do. You're going to come out with a short report, okay? So first off, they calculate SoFi's real personal loan charge-off at 6.1% versus 2.89% reported. Loans are disposed of days before charge-off threshold, understating losses that feed into fair value models, producing $259 million in unwarranted gains. SoFi's student loan business appears to exist primarily to generate fair value gains for management bonuses. SoFi uses a discount rate of 27 basis points below the 10-year treasury, implying a negative risk premium. SoFi's secured loan business is really seller-financed wholesale loans. Oh, this is interesting. SoFi's loan platform business isn't a capital-like toll booth. It appears to be disguised, borrowing booked as fee income, structurally to Enron's... Enron, like, this is where they're comparing it to Enron, right? Like, this is fascinating. We also see $312 million apparently an unrecorded debt. In the process, SoFi appears to have borrowed $312 million that we believe is not reported in its financials. The loan platform business that replaced secured loans looks like it's disguised borrowing, booked as fee income. Once again, comparing it to Enron. After adjusting for what we view as inflated marks, off-balance sheet borrowings, and capitalized expenses, we reduce SoFi's 2025 adjusted EBITDA by 90%. from $1 billion to $100 million. Management gets paid for diluting you. Okay, so obviously Muddy Waters is gonna attack, right? Now my first reaction to kind of reading through this is like, here's what I thought. I'll just give it to you exactly how I thought. I was like, oh, that's it? I expected more. I'm just going to be honest with you guys. I expected a lot more. I was like, man, if you're going to come after a company like SoFi, you've got to come like stronger than that, right? So Google Gemini. What does Google Gemini have to say about this? And I'll share more in-depth opinion perspectives here. One, the financial engineering bonus target claim. Muddy Waters claim management uses loan marks and off-balance sheet structures to hit bonus targets. Rebuttal. Anthony Noto has famously never sold a share of SoFi. If he was engineering for a bonus, he'd be cashing out. Instead, he bought 28,900 shares today at open market. True engineers don't double down with their own cash during a crash. And yeah, SoFi stock has crashed. I mean, it was $16-something today. The peak on SoFi, I think, was somewhere around $30, $32. So it's down roughly about 50%, right? The $312 million unrecorded debt. Muddy Waters claims there's a material misstatement of at least $312 million in unrecorded debt. GAAP compliance. This likely refers to the warehouse facilities or special purpose vehicle structures standard in fintech lending. These are disclosed in SEC filings, calling them unrecorded because they are off balance sheet per accounting rules. It is a semantic trick, not a discovery of fraud. Charge-off rates. This is a really important one, in my opinion. Listen. Charge-off rates. Muddy Waters saying 6.1% versus 2.89%, right? Short sellers often calculate charge-offs using gross figures or different denominators like lagging the data to create a scarier number. SoFi's 2.89% is a GAAP audited, generally accepted accounting principles, annualized figure. If credit were truly that bad, SoFi wouldn't have reached sustained GAAP profitability starting in late 2023. Student loan fair value gains. The claim, the student loan business exists only to generate fair value gains for bonuses. That's actually kind of hilarious. Student loans are SoFi's top of funnel product. They bring in high income earners, doctors, lawyers, who then buy insurance, mortgages, and invest. Fair value accounting is the industry standard for loans held for sale. It's not a bonus hack. It's how the assets are priced. Loan platform disguised as borrowing. The loan platform business is a wet funded forward flow, which is just borrowing. Forward flow is the bedrock of capital light fintech model. Selling loans to institutional partners isn't borrowing, it's liquidity management. This is how SoFi recycles capital to grow without needing to make an infinite balance sheet. $950 million overstated. EBITDA is inflated by $950 million through various accounting abuses, claims Muddy Waters. Rebuttal. While EBITDA can be managed, net income is harder to hide. SoFi's shift to GAAP net income profitability, which includes stock-based compensation and marketing, renders the EBITDA, earnings before interest, taxes, depreciation, amortization, by the way, if you're wondering, EBITDA, debate secondarily. The cash is flowing and the GAAP bottom line is green. So, my thing here is, does this make me as a SoFi shareholder not want to buy SoFi shares? Does it make me want to sell my SoFi shares? Certainly not sell. And I kind of am a little upset I didn't buy some SoFi shares here today. I wanted to kind of look over the report and those sorts of things. By the time I got it all done, the market was closed. So if anybody sells out of SoFi tomorrow or something on this report, I might step in and buy some shares. And I'm going to continue to pick up SoFi shares here and there under $20 for a while. This is a stock I have heavily bought under $10. And so the fact that I'm willing to pay, we can call it up to $20, I think speaks volumes for the company and kind of where I believe it's going over the years and those sorts of things, right? When companies do these short reports, they usually go into some sort of finite details like this, like, we think it's 6.1% versus 2.89% and those sorts of things, right? And I think you kind of miss the forest for the trees type situation in regards to this. Like, if we want to debate, is this, should they be doing it this way or that way, right? Like, the short sellers are never going to be 100% happy. Like, it doesn't matter what company there's no company that exists in the entire stock market that I could not make a bear thesis on. Let me say that one more time. There's not a company that exists in the stock market that I couldn't make a bear thesis on. I mean, even from the top, we're about to get into Nvidia. Listen, even with Nvidia, they've claimed Nvidia's doing, let's just call it, suspicious things, and somehow getting chips into China, like that. People have tried to claim that, right? They've claimed, companies are double and triple ordering chips. And so there's a bunch of million different things that people have claimed in regards to even a company like Nvidia. So a company like SoFi, it's easy pickings to, make a short thesis on, right? And come out with a short report on it. And so I don't mind it though. Let me be very crystal clear about that. I love short reports. I understand for noob investors, they get very frustrated by this. I actually appreciate it because these guys, it's their job to find anything suspicious. And I'm like, that's all you found? They probably spent weeks, if not months, going through SoFi to try to find any little things that are like suspicious, sketch, right? And I'm like, that's all you could find? That's it? Oh, okay. Thank you. Like, I'm like, you literally just went so in depth. Like usually these guys are trying to find any little thing, right, to try to make them look bad. And I'm like, that's it? You went through the whole company for weeks or months and that's all you found? I actually feel, if anything, I feel even more comfortable about SoFi today than I did yesterday based on the short report. Because I'm like, gosh, that's actually all I found? Okay. So that's kind of my opinion perspective. And I don't mind it with my companies. I actually like it. But that's coming from somebody that's been in the market, 17 plus years now at this point in time. And I think the other people that kind of get frustrated by this are people that might have call options on SoFi, right? You might have $25 strike on SoFi. It's $16 today. And you're looking at the short report and you're like, you'll be flipping my flapjacks right on the floor. Come on, man. That's why you don't mess with any of this crap, guys. Just stay invested in the great companies you love. You want to own, you love SoFi. You believe it's going to go up a lot over the next year, over the next several years. Just own the stock straight up. Don't play the call option game. You don't know what can happen in the market. Market could crash for all we know. S&P 500 could go down 20, 30, 40% over the next year. You don't know. Like, that probably won't happen, but it could happen. And what are you going to do with your call options then? They're all going to expire worthless. More short reports on SoFi and, people get scared and panic sell and don't buy the stock, right? So the stock just flounders in the $15 to $20 range and you've got, options that expire a year from now at $30 strike. No, we're not playing that game, man. Just focus on buying great companies, own more and more shares of great companies that you love for the long term, and keep it simple. As they say, keep it simple, stupid. You don't need to complicate this game and stress yourself out because now a short report came out and your stock got wrecked in the short term, right? Alrighty, now let's get into Nvidia, AMD talk, and then SaaS stocks and what's going on here. Some very important stuff we're about to get into.
Stock's down 30 cents. Your stock's up 22,000% in the last decade. Should we care about the last half hour?
Well, I guess we all do. Our growth is accelerating at a larger scale. That's surprising for people. And the end markets are really growing. We've reached this point in AI called the inflection of inference. And so we've reached the inference inflection. And so, our growth is accelerating. We would love to see everybody enjoy it.
Well, people got a little trapped by the 500 billion to a trillion, and I like that, over 2025, 2027. What trapped me was that when we were talking about Michael Dell yesterday, that Jim, do you remember when I told you?
Let me be very crystal clear about the issue with Nvidia. Let me explain this in the simplest way I possibly can to everybody watching this right now, okay? Listen, Nvidia has amazing numbers. They're going to continue to have amazing numbers. We all know that. The issue is, it's like if the kids across the street had a lemonade stand, okay, and let's say there's only a few companies, there's only a few neighbors around the neighborhood that can really buy up their lemonade like crazy, right? And there's only a few companies that really can change the numbers in any sort of material way, right? A few people in the neighborhood. I keep calling them companies. A few people in the neighborhood. So we're all spending money like crazy at this lemonade stand. And next thing you know, we're basically paying everything extra that we get paid from our businesses or from, our jobs. Every last penny is now at a point where it's all going to a lemonade stand. Well, now the kids at this point in time, they're going to have a lot more trouble, like having revenue go higher, because like all the people that could spend heavily at this lemonade stand that could change their numbers in a material way, they're already maxed out on what they're spending. And the only way they could spend more at the lemonade stand is if they start taking out crazy amounts of debt. And, no one wants to do that, essentially. That's what's going on right now for Nvidia. These companies like Meta, like Google, like Amazon, all the big ones that really materially matter to Nvidia's numbers, they're all pretty much maxing out now what they can spend on these chips. Like they don't have a bunch more extra money. They're basically going to be using pretty much all of their cash flow on CapEx now at this point in time. So there's not like this big massive amount more they can spend. And you could say, well, what if some small companies buy Nvidia chips? Yes, but that's not going to materially change Nvidia's business, especially with how big the revenues are getting. Because now we're talking about a company that's doing hundreds and hundreds and hundreds of billions of dollars of revenue a year. So some small AI startup that is successful and then spends $400 million on Nvidia chips is a rounding error. It's a rounding error. Like Jensen's been talking about doing $1 trillion plus in just a couple chips over the next basically over this 2-year span. $400 million in chip orders is nothing for Nvidia now. So that's the issue. I hope I explained that properly in the easiest way possible. I hope that hit for everybody. Let me know in the comments section. Okay.
That ChatGPT could be big, and I said, well, yeah, I do. 10 years ago, and he goes, NemoClaw. He said, NemoClaw, this may be even bigger. I start my morning with NemoClaw. Could you explain to people why this may be what we're thinking about over the next 5 years and not something involving margins over the last 5 minutes?
Well, first of all, I said at the keynote, and I referenced a number I used previously because I want to give everybody a baseline.
We need that.
And so last year I said that about this point that we had $500 billion of high confidence visibility of Blackwell and Rubin. That's it. Obviously our company sells other things.
Right.
We have CPUs, we have storage processors, we have networking, and so we have all kinds of things that we sell in addition to that. We have $500 billion worth of visibility, and at this point, with another 21 more months to go to the end of 2027, we already have high confidence visibility of $1 trillion plus of Blackwell and Rubin. Not anything else, just Blackwell and Rubin. And so, we still have 21 more months of new orders coming in. We still have all of the other things that NVIDIA sells. And so I just wanted to give everybody a baseline. The ecosystem needs to know directionally where NVIDIA is going. Now, of course, we plan with the supply chain. We help everybody with their capacity building. We prepare all the technology partners so that we can support $1 trillion worth of Blackwell and Rubin. And so it's an incredible thing.
Another issue with Nvidia stock here, and you're looking at it and like, man comes out talking about $1 trillion just between this year and next year in a couple chips. It's insane, right? And it's like, how is the stock not moving short term? Well, listen, they just killed off any anticipation of epic numbers. Nvidia stock was really, really exciting from basically the very end of 2022 into the end of 2024. And the reason the stock was so exciting at those moments is like, you didn't know like what the potentials were for Nvidia. It was just, they were coming in with these numbers that was just jaw dropping. What? They just did what number? How were they growing like that? And it was so exciting, right? Now he just laid out like, well, here's roughly what we're going to do, and now you can run some numbers on the other sides of the business and maybe they sell some chips from here, but it kind of killed off all anticipation. And so for the short term, it's not a good thing. If you're a long-term investor, I think it's a great thing though. I think it's more impactful that you know roughly what NVIDIA is expected to do over the next year or over the next several years in regards to revenue. So I think it'd be very helpful from a long-term perspective, but from a short-term perspective, it kind of kills excitement is what I would say about that. Like, oh, okay, we know what it is now at this point.
Bought Grok in December.
Yeah.
What I heard yesterday, maybe my biggest takeaway, was that it's already going to be making you not money, but a huge amount of money, and that's not part of the trillion.
No. Yeah, we started production of Grok version 3. It's a really, really special company, and we're going to add Grok, not to every part. Vera Rubin is so incredible that it's really hard to add value to Vera Rubin. You know, that engine is so incredible. And so, but there's some part of the workload, I think about 25% of the workload, where we could add Grok to it. And so for 25% of the workload, we could increase our opportunity even more. And so
people will be paying for this.
Yeah, you know, Nvidia is obviously just an amazing, amazing company. You know, legendary is what I would call it. Okay, what we got going on here with X? Let's figure this out. All right, here we go, ladies and gentlemen.
The market has really started to question the value proposition for legacy software.
This is really important if you're buying any SaaS stocks or you're thinking of buying any SaaS stocks here.
Companies over the past few months, and with the rise of agentic workflows, many people think these platforms can be vibe coded away. I'm curious how you see AI working with those software companies to prove that they will be valuable for yourself.
Yeah, and so please tell the retail investors they're just absolutely wrong. And it's not even my business to protect them. You know, but right is right and wrong is wrong. Let's just use one example. Synopsys, okay? Or Cadence, or any of the design tools. The limit of their business is butts on seats. There are only so many engineers. If there were more engineers, they license more tools. If there were more plumbers, you get to sell more tools. If there were more carpenters, you would sell more tools.
Yeah, pretty simple.
You know, and so if there were more engineers, then you sell more tools. But in the future,
100%. Think about it. You know, put it very simply. Imagine for a moment you have a hardware store in a little town, right? And, you know, your little town has a population of only, 100 people, right? And of those, the amount of people that would actually come to your hardware store for something, so adults, let's say the amount of adults in the city is like 50, right? And the rest are like children or like people that are super old, so they can't even, go to the hardware store. So you have like 50 customers. Well, I guess you would probably be able to sell a lot more things from your hardware store if the population was a lot bigger. What if it was 500 people lived in your town, right? Or 5,000 people? Like, it's a much bigger opportunity to sell a lot more things, right? So, yeah, 100%, and that's what he's alluding to here as a point, is these software companies have always kind of been limited in regards to how many people use them because it's like actual humans. But if agents start doing this, then you can have technically like unlimited.
We're going to have agentic engineers. And what are the agentic engineers going to do? Manifest transistors? No. The agentic engineers are going to use the same tools we use because when we're done with using the tool, it needs to put it back into the structured data that I can understand. Because if I can't understand it and I can't control it, this is back to the controllability questions we keep coming back to. Is SQL going to die because agents are here? No, SQL's, that's where our ground truth of business is going to be stored. And when the agents are done with their work, please put the work back into SQL. So that if I want to go interrogate it, I can go interrogate it. When the agent's done with design, it's going to use Synopsys and Cadence, and it's going to go back into the file systems and the data structures, the ground truth of the design of Cadence and Synopsys. And if I want to reproduce it exactly, not probabilistically, if I had an agent, if I used AI, deep learning, to generate my chips, it's going to probably work. I can't have it probably work. I need it to have it exactly work.
Yes.
And so I need to have a specific ground truth. And the tools, the Synopsys tools, keeps it coherent. Now, because I have agents, the number of Synopsys tools that we have to license is probably going to explode.
Yeah.
Not the other way around. People have this weird idea that the AIs are going to manifest and generate the transistors from zero. Are you guys? That's like nano banana. I'm going to, they kind of imagine NVIDIA engineers going nano banana, you know. By the way, I love nano banana. Nano banana is great. But you can't design chips that way. Are you guys following me? You got to get it crafted layer by layer by layer because you need it to be verifiable, you need it to be understandable, you need to be repeatable, controllable. All of those things you can't be probabilistic.
Yeah, 100%. And Jensen also had another great way of putting it. He said, okay, imagine you have, Optimus robot or whatever robot, who knows how many years away that is, 5 years from now, 10 years from now, 20 years from now, 30, whatever. Okay, eventually we have robots in the house, and the robots are then like going out and doing landscaping in the yard, and they're cleaning dishes and all that stuff. Is the robot going to say, you know what, let me go ahead and let me build a brand new dishwasher? No, it's going to use the existing one that is there, right? Is it going to say, you know what, let me go ahead and make a whole new leaf blower? No, it's going to use a leaf blower. It's going to use the tools. And so that's the same thing. Like, people think like, oh, like Salesforce is going to be replaced because they have, agents. And I'm like, no, they're going to benefit huge from agents. Are you kidding me? Like, this is going to create a much bigger TAM for them long term, like much bigger TAM for them long term. Now we're talking about their tools being used more and more. Why would they want to try to create some new Salesforce software of some kind when you have one that already works perfectly? You don't need another one, right? Why are we going to try to duplicate Slack? It's not going to make sense. It's going to end up probably being a worse product, and it's going to create a whole bunch of problems inside your organization. Are you kidding me? Like, that's insane. And so, like, you can go through company after company, and it's just like this whole thing about like, oh, everybody's going to be eliminated is just ridiculous. It's absolutely preposterous, But anyways, that's where the market's at right now. Okay, next one up here. I think this one matters even more for AMD if you're an AMD shareholder out there.
Geez, Alex Kantrowicz. Alex, good to see you. I saw you here at the exchange yesterday off camera, but let's talk about Nvidia. It's weird. Nvidia sort of has to make the case at this point. It's been doing so well that it continues to do well and maybe can do even better. What have you found to be the most notable points out of GTC?
Well, first of all, it just highlights the expectations on this company. Only Nvidia could tell you that it's going to make $1 trillion on two products or thereabouts over the next 2 years, and people view that as a disappointment. But you have to think about the environment that we're operating in. We're in a world right now where the CapEx among big tech companies is expected to be about $700 billion this year, up from $400 billion or so last year. And so who knows where it will go in 2027. Maybe it'll be $1 trillion if it keeps up on this pace. So if you're looking at maybe $2 trillion are being spent over the next couple of years, for Nvidia to say we're going to walk away with $1 trillion, for people are starting to, they're expressing disappointment about that. But ultimately, I think the business is in really good shape. They are going to capture the lion's share of that CapEx. And as AI continues to accelerate, we were talking yesterday about all the different product uses that are available today that weren't available just a couple of months ago. I think Nvidia is going to be poised to capitalize there.
For a while, a few months ago, people were excited bidding up Nvidia stock because of how much folks were buying it. And people were excited about the hyperscalers, Google, Amazon, Microsoft, about how much the potential was for them to grow in AI, even though they were spending a lot. Now there seems to be some lukewarm sense on both. How do you balance the opportunity for the infrastructure makers like Nvidia, even though Nvidia is kind of like a singular name there, and the margins against what it means for these big companies that are spending all that money on the infrastructure?
Well, first of all, there was a frenzy in stock buying over the past couple of years where people just saw the growth that Nvidia was turning in and they wanted to be a part of it. So they ran to it. But right now, we do know that there's a lot of revenue forecasted for Nvidia, and it has sort of stagnated a little bit over, at least in 2026. So I think there is room to grow there. But as far as where the margins are going to be found, I would argue that even those who are deep within this, whether they're the chip makers, the application builders, the hyperscalers, hyperscalers, they're not quite sure. And there is an argument to be made for every single one of these categories that they could be the one that capitalizes the most, or they get nothing. Think about model building, for instance. If you're building something as powerful as maybe artificial general intelligence, that should be economically valuable. But if somebody else builds it, can you hoard it? Can you charge a premium over it, or does it commoditize? Same with chips. We're seeing this with the inference conversation around Nvidia right now. You would think that Nvidia, as AI gets adopted more, would be in the best position, and I think it probably is. But as we move from training to inference, it's going to have much more competition. So my perspective here is that it is dynamic, it's volatile, it's changing rapidly, and investors are just going to have to hold on to their seats for the time being as we see this shake out.
One of the areas we perhaps don't talk enough about is the software for data management that sits in between the infrastructure and the applications.
Before we go further here, so listen, Nvidia obviously got out in front of AMD by several years, right? AMD's finally in the catch-up phase, and they're, obviously with the 450 going into production here, and that obviously scaling in the back half of 2026 in a major way. That's, AMD finally being here on, actually in the race with Nvidia for the first time. So it's very exciting times for AMD. But listen, the thing you got to understand is training and inference, right? Think about training as these models need to be trained, and think about inference as people actually using them, right? And Lisa Su has really positioned the company in a very strong way, and she's talked about this many times, for inference, which inference is the much bigger long-term opportunity out there. When we think about this training opportunity and what has transpired over the past several years, that's a great opportunity. Obviously, Nvidia is not a $4 trillion+ market cap for no reason, right? It's been an incredible opportunity, but just understand the inference opportunity long term is much larger than this, right? And understand between AMD and Nvidia, the exciting thing is AMD is going to have major acceleration in growth throughout 2026 and into future years, where Nvidia is going to have shrinking revenue growth. Okay, shrinking revenue growth, not shrinking revenue, shrinking revenue growth. And you can't debate that. This isn't a debate. This is facts. If you think Nvidia is going to magically start growing revenue 100%, 150%, 200%, I don't know what to tell you. It's not mathematically possible because companies are already starting to reach max out levels in regards to their cash flows and already spending on this stuff. But when it comes to AMD, they're about to go through major revenue growth acceleration here. It's just math. It's not opinions. It's just math in regards to the subject. So, and that's why AMD, if you look at since Liberation Day, AMD's pretty significantly outperformed Nvidia. But I think this is still early. I think over the next year or two, get ready to see the outperformance of AMD versus Nvidia. It's going to be pretty darn dramatic in my opinion. And that's no shade at Nvidia. Nvidia is an amazing company. And I think the Nvidia stock could be fine. But just understand AMD is going to be a beast over this next bit of time.
About also how all this data gets stored, the databases that make it suitable for AI, how you manage it, the data lakes, thinking about the likes of Snowflake, Datadog, etc. How do you think about their place in this ecosystem and maybe their valuations or the amount of conversation there is about them relative to the rest?
Well, I think they're going to be very important. And it goes to this broader conversation around, will software be worth something or will it be worthless as AI takes off? Well, even if you go into an era where you're doing much of your computing within the chatbot, you're still going to need good data to be able to work off of. It's not like all of that's just going to be stored in the memory of ChatGPT, no matter how good it gets. So I think these middle layer companies do play a very important role, and they're not going to be replaced anytime soon. So even though we might see some hysteria AI can build an app, which it can, and it's impressive, I think it's very important for investors to sort of separate that functionality out from the core infrastructure that a company like a Snowflake or a Datadog is providing.
Yeah, and I think another important thing about AI, right, is people think, people have seen the improvements in AI over the past few years, and it's very impressive, right? But it starts to get a lot harder from here. And people think artificial general intelligence, AGI, it's right around the corner, right? It might be, but it might not be. It might be a long, long time from now in regards to, really talking about it in those terms. And I'll put it to you like this, right? You know, some of you guys have had kids, you know, and you have a kid, and usually the first 3 to 6 months, basically they like do nothing. They just lay there and you change their diaper and you feed them, and it's just not a lot, right? And then kind of around 6-month mark, then they start making some facial expressions. They start moving a lot more, right? Eventually they start crawling, and then they start walking, and then they might start running, you know, as the months tick on and years tick on. And so you see this improvement in your child, and you're like, oh my gosh, like they're going to start flying, right? Because I mean, look at, they went from nothing, they couldn't do anything, to then they started moving, to then they started crawling, to now they're starting to walk, now they're starting to run. Give it another year or two, and they're going to start flying like a bird, right? You know, and obviously it doesn't work like that. And so the same phenomenon could happen in something new like this. Like, you know, if this was back in the day, like we all know it's common sense now to understand, like, oh, you know, just because a human's like learning rapidly in its first few years doesn't mean all of a sudden now it's going to be like super genius and it's going to fly and, you know, be a superhero. It's not the way it works, right? So the same thing here is with this technology. It's been incredibly impressive the first few years on how this is built out. But if you think like, oh, it's just going to continue at this rate or something like that, no, it's a massive slowdown. And then people are going to be like, oh, crap, like this is hard. Like, why is it not getting exactly what we want, right? And yeah, even myself using AI more and more, the more I'm being less impressed, actually. Initially, when I started using AI, oh, geez, this is insane. The more you start using it, and I've started using it, I would say daily now at this point in time, the more and more I'm starting to see flaws in different models. And I'm like, oh, it can't even do this. And like simple stuff too sometimes that I'm like, oh, like it can't actually read through this. It can't understand, like, this is what this person said, this is what this company said, this is what, and I'm like, oh shoot, like there's a lot of work still to go in regards to this. So anyways, I think that's just, you know, throw a little bit of cold water on this whole situation. And at that moment, you know, companies might realize, the big spenders, like, oh, we might have to slow down a bit in regards to spend. And that's the moment it starts to really hit Nvidia, and that's when Nvidia's margins come down. And that's the scary part. And that's the part where people are like, that's why they're not enthusiastic. Everybody knows Nvidia numbers are going to be banger this year and next year. They're worried about 28, 29, 30 numbers, right? And so Nvidia is kind of stuck in a place when it's with the stock price. Like I talked about this last year, of just kind of being stuck between about 125 and the 200-ish range, because you can't get any major buying pressure to come in and say, yes, we love Nvidia for the long term. It kind of just is a little bit more of a trader stock in the short term. People trading back and forth shares, and little market goes risk on, maybe it bids up a bit. Market goes risk off, it bids down a little bit. Like, you know, it's just the way it is. The main pinned comment down there today, if you're looking to apply to our private stock group, private wealth group, get access to 1000xstocks.com, all those good things, that will be the main pinned comment down there. All my course curriculums, private Discord chat, the SoFi chat, the AMD chat, all those ones as well. I believe we even have an Nvidia one as well. And then if you want to follow me on X, that will be the second pinned comment down there. That is free to do so if you use a platform. Very exciting weekend this weekend. I did go ahead and get the keys to my new house, and I took this picture for you guys from the backyard. It's built on a mountain. It overlooks the whole city. I can't wait to show you guys, but I'm not moving in for a while, and the reason being is I got a bunch of projects to get done at that house, you know, here now that we closed on the home. So exciting times. I'm definitely looking forward to getting in there, but that will be still a bit of time from now, okay? Alrighty, guys. In this video here today, a lot to go through. We're going to go through 7 stocks to buy and hold forever. This is a Warren Buffett inspired video. If you know Buffett and his investing philosophy, he usually thinks about companies that he wants to invest in for decades, or potentially take it to the grave type stocks, right? And so I've thought about it, and I try to say, what are the 7 stocks in the stock market that I feel comfortable could provide amazing returns over decades, right? And like, you don't have to sell them. So they have amazing, like, let's call it amazing moats around the business, right? And so that's what we're about to get into in this video here today. I hope you guys get a lot of value out of it, not just from knowing these 7 stocks, but like why? What is it about these companies' business models that can make them relevant decades from now, right? I appreciate y'all for joining me. I hope you appreciate all the time I took for doing this one for you guys here today. I've been prepping this video for like a lot of hours. Let's just put it that way, okay? And I've also put so much time into thinking like, what are the 7 stocks to buy and hold forever that are in the stock market? Because there's thousands of stocks, okay? So I found the 7 best ones. All I need from you guys, just please smash that like button if you haven't already. That lets me know you enjoy a video like this. Additionally, make sure you're subscribed here to the channel. If you enjoy enjoy a video like this, you want to see more videos like this or my other videos on the channel, make sure you're subscribed. Higher probability YouTube will show you my videos in the future, just as the sign says in my garage. Hit the subscribe button, smash the like button. Okay, ladies and gentlemen, number one of these 7 stocks is Amazon, otherwise known as Amazingzon around these parts. This stock has provided a 173,000% return over time. Absolutely incredible company, and it's at a discount right now. Now, what makes Amazon's business model so amazing to hold forever, right, the rest of your life, basically, is the e-commerce opportunity. Like, this is not going away. This is just getting bigger in terms of people getting used to getting things delivered to their home, right? And when it comes to Amazon, they have the best selection, most of the time at the best prices, and they've just gotten everybody so used to going to Amazon to order things, whether it's on your app, which is on your phone, right, which I certainly do, or whether it's actually going to Amazon.com on your computer. And, like, this is my go-to. If I need anything nowadays at this point in time, if a light bulb goes bad and I need a light bulb, the first place I go, Amazon. Let's order a new light bulb, right? If I don't know what type of light bulb it is, I take a picture of it through Amazon's little AI thing, and it tells me, oh, you need to order this light bulb, right? And it's gotten to the point where just about anything I can think of now, I'm like, go to Amazon to order it, right? So the e-commerce opportunity continues to get bigger and bigger and bigger, and that business will be incredibly profitable as the years tick on. And they really have no competition in this market, just to be quite frank. Lots of companies try to sell things online, but at the end of the day, there's a one-stop shop if you want to look for anything and get it delivered to your house. And Amazon is the winner chicken dinner by a mile in this market, right? From there, they have their AWS business. This is a cloud business, and when you think about the backbone of companies and the internet, just to be quite frank, really the cloud is where it all happens, and AWS is the biggest player in the cloud market, and they have a dominant market share there as well. Microsoft has a very successful business, obviously, in this market with Azure. Google Cloud does as well, and there's a bunch of smaller players. So there's no doubt it's a competitive market, but so was in e-commerce, and at the end of the day, Amazon won that, and Amazon is winning when it comes to AWS as well. Look for likely accelerating growth rates in this business over time. Now, additionally, when we think about the ads business, this is a business that a lot of people don't talk about or think about, but the ads business just passed $68 billion in annual ad revenue. Now, this is incredible because Amazon has so many people going to Amazon.com all the time, right, in the Amazon app, that they now have a great ability to serve up ads to those individuals, right, to make a bunch of money off that. And if you know anything about the advertising business, it's straight profit business, right? Now, additionally, they're buying up more and more content. That can mean even sports rights and other things that basically helps them boost up that ad business as well, which, if we think about that over the next many decades, it should get bigger and bigger and bigger, right? This is Amazon's revenue over the past several years. We're looking at 1000xstocks.com here. I mean, it's incredible, right? It's just consistent growth. The biggest question for Amazon is, what are the growth rates per year? Are we talking 7%, 10%, 12%, 15%, or more toward 20%? Now, additionally, the net margins of this company are still very low. They're kind of in the 10%ish range for net margins. Long term, I think Amazon will be a 20% plus net margin company, but that's long term. We're talking 2030s into the 2040s, right? But there's a lot of room to grow that net margin. And keep in mind, Amazon's going to hit $1 trillion plus in annual revenue here in the next few years. Start running a 20% net income margin on $1 trillion plus revenue business, and you can start doing several $100 billion a year in net income. Incredible numbers, right? Now, additionally, here's what's really exciting about Amazon. You're getting it at a huge discount right now. This is historical PE ratios for Amazon just over the past few years. I could back it up way further, and you'll see the historical PE ratio for Amazon was incredibly high. Right now, you're getting the stock dirt cheap on a PE ratio basis. It doesn't happen often, so take advantage. Additionally, operating cash flow continues to build to new all-time highs for this company as well, right? Now, they're spending a ton of that cash flow, which is making their free cash flow not look that good right now because they're spending that on the AI opportunity. But Amazon's spending so heavily there because AI should help their e-commerce business accelerate, serve you up different products, ads, things like that will make you buy more things, right? Which will make companies more money and want to spend more ad dollars with Amazon. Think about that. It's like a perfect cycle for Amazon. So it's very important Amazon gets AI right, and they're spending a fortune on it. Additionally, the AWS side of the business. That's the biggest opportunity for for Amazon when it comes to spending on AI and spending on AI infrastructure. If they can be the company to go to for your AI backend and all things related to AI and Bedrock there, I mean, my gosh, that's an incredible opportunity for this company over the coming years. So that eats up their free cash flow for right now. But Amazon, listen, Amazon has cycles, and then I'm about to show you my projections for Amazon over the next several years, essentially. But listen, Amazon has a history of spending incredible amounts of money. People question it at the time. Like, why are they spending this much? I don't know about this. This happened with the e-commerce business as they built out massive amounts of warehouses and they bought up vehicles and they got fleets of vehicles to start doing their delivery and went away from just having UPS and the other companies deliver all their products, right? People are like, I don't know about this. And they start buying airplanes. People are like, I don't know about this. And then they spent so much money on AWS over the years and people are like, I don't know about this cloud thing. Like, is it really going to be that big? Is it going to be that profitable? Is it going to be that meaningful? They're spending so much. There's a lot of questions. Now they're spending a fortune on AI. A lot of people are like, why are they spending this much? I don't get it, right? Amazon has a history of a massive spend cycle, followed by then huge revenue ramp, followed by then huge profit ramp. And don't be surprised if they execute on this once again, right? And remember, you're thinking about these companies not just for the next year or two, right? You're thinking about these companies, we're talking about long-term companies. We're thinking about these for decades to go in the future. Look at this. This is my base case. This is just what I expect for Amazon over the coming years. 12% revenue growth per year, 26 to 29, 18% net income growth, 26 to 29, 33 to 38 PE ratio, because Amazon's got growth for decades to go in the future, right? That gives me a compounded annual growth rate on the low end of 22% and on the high end 28% with not a high risk stock here. So Amazon's an incredible opportunity. That's why I want to feature it number one here today out of these 7 stocks. It's one you can buy and hold forever, right? Now, I'm showing you guys a lot of things on 1000xstocks.com here. If you want access to 1000xstocks.com, click the pinned comment down there today, the first pinned comment, and you can apply to join my private group. That will also give you access, full access to the premium software at 1000xstocks.com that I use on a daily basis. It also gives you access to my entire library of premium courses. Become a Master of Stock Market, Millionaire Playbook, Stock Options Mastery, Dividend Investing Mastery, Financial Statements Mastery, and How to Run Valuations Properly, the Valuations Mastery. Also gives you full access to exclusive weekly videos and my Discord chat with, we have 3,000 plus members in there. So many folks with multi-6 figures, 7 figures, 8-figure investors in there. 50K net worth minimum to apply to join us in there. And we'll send you your Steel membership cards when you join us in there. Second pinned comment down there today. I'm putting, because since this video was inspired by Warren Buffett, I'm putting 2 free books for you guys. That will be the second pinned comment. This one is Warren Buffett, The Art of Compounding. Goes into key lessons on how Warren Buffett built his wealth over the years. And you'll find out a lot of things that you probably didn't even know about Warren Buffett and how he did it. And we did one on Peter Lynch as well, Power of Common Sense. You're going to learn so much from those books. It's going to be incredible. It's literally free to access that. That will be the second pinned comment down there. You can click on that and we'll send it over either via email or via text, however you want to receive it there, and enjoy those and learn a lot, okay? Alrighty, guys, let's get into the second one of these stocks, and it is SoFi Technologies. This is a $17 stock here today. It's up 60% from its IPO. Now, what makes SoFi pretty amazing is this company is not just a one-trick pony. They got one product that's successful. No. This is the go-to platform for a lot of millennials and especially a lot of Gen Z when it comes to banking, personal loans, credit scores, investing through SoFi, mortgages, student loan refinancing, even credit card offers, all those sorts of things, right? And this company has made a great early customer base, I would call it, for their company. Now, they've already reached pretty big scale, but if you compare them versus, let's say, like Bank of America, Wells Fargo, JP Morgan, they're still small when it comes to those guys, but they're eating up market share year after year when it comes to grabbing new members, right? And they're really mobile focused first, which is a genius strategy. Now, this shows you SoFi's revenues over the past several years, right? 2020, $750 million, then to $1 billion of revenue, $1.7 billion of revenue, $2.9 billion of revenue, $3.7 billion of revenue, and last year, $4.7 billion of revenue. One of the amazing things SoFi does, and Anthony Noto does, who's running this company, is they don't always take the risk on loans. A lot of times they'll sell off their loan portfolios to other companies, and those companies can then take the risk for that. And so Anthony Noto is trying to keep the company as asset light as possible and to be more of a, let's call it a little bit more of I would almost describe them a little bit more as a fintech than just traditional banking, right? Now, Anthony Ngo is doing a great job running the company. He's positioned the company for the next several decades. It's not like he's just thinking about, positioning them for this year or next year or something like that. He's positioned the company for the next several decades. Because when you acquire somebody in the banking space, you can keep that person many times for life as a customer, right? Now, company right now, $22 billion market cap on this company. Think about somebody like a JP Morgan, $771 billion market cap. Now, SoFi is not going from a $22 billion market cap to $770 billion tomorrow. But if we think about the next 10, 20 years, does SoFi have that sort of ability? I think they do. It'll be brick by brick, and they'll keep building, but I think they can pull that off, right? Now, I challenge you to find out more about SoFi. Listen to the conference calls of this company. You can do that right through 1000xstock.com. You go to the earnings call tab. You type in whatever ticker symbol you want. We do an AI transcript for you. We also have the regular transcripts for you. And we have the conference calls. And you can listen to them at whatever speed you want. You want 2x speed, listen to 2x speed, or 1.5x, whatever you want to do there. Okay. Listen to the SoFi conference calls. Learn more about the company. Understand the philosophies, the process, how they're acquiring members, all those sorts of things. I think those conference calls are amazing. Alrighty, guys. Number 3 of these 7 stocks up here today to buy and hold forever is Meta Platforms. This one is about a 1,400% since they went IPO about, we can call almost 15 years ago or so now at this point in time. Now, when it comes to Meta, keep in mind, this is my number 1 biggest investment in the public count. I'm up 539% on it, and this is a position that's worth $627,000. My public count, I show it many times in videos. The private group gets to track every single move in there. Remember, I talked about the private group over there. They get to see every single move, every single buy and sell I do in that portfolio every single week, right? And so for that portfolio, it's very important I don't make mistakes and I get it right? Because it's known publicly. And so when I have a company like Meta and feel comfortable having it as my biggest position, it speaks volumes about that specific company, right? Now, when it comes to Meta, the incredible thing about this company is 3 billion plus users on Instagram, 3 billion plus users on WhatsApp, 3 billion plus users on Facebook. They also have Messenger, which is right around 1 billion users, roughly, ballpark. And then they have Threads, which they started, Threads is probably only maybe a year or 2 years old now at this point in time. It's kind of a bit of a ex-competitor. And that's up to, from my understanding, 400 million plus monthly active users now at this point in time. So they've really dominate, like messaging, the internet in general, right? Now, the thing with Meta is it's very attractively priced. It's not like you're having to pay some crazy P's for this company, despite it has very strong growth rates. Forward P in the stock somewhere around 20. That's extremely fair for one of the best income statement, balance sheets, cash flows in the game. Come on, man. That's a steal deal. Now, companies spending huge money on CapEx right now. They're another one of these that's spending huge on AI opportunity. They're already starting to make a lot of money from this. And the reason is with AI, they're basically being able to show people more relevant posts that they're interested in, which makes them spend more time on the apps and share more and those sorts of things, right? Now, additionally, if time spent on the apps goes up, right, that gives them ability to show you more ads, so they can show you more ads, right? Additionally, they're also using AI to get the advertisers to get better ad spend, so they're not showing the ads to people that won't buy. You don't want to be showing ads to somebody for a product they're not going to buy, right? That's no bueno in regards to that. And so from several different fronts, they're using AI and already generating the revenue, and that's why you're seeing their revenue blast higher. Their revenue recently has been up in the mid-20s. For a company that's as big and established as Meta, you wouldn't be thinking they're growing revenues in the mid-20s, but they are. And a lot of it has to do with AI, right? So look past the big ad spend, or the big tech spend right now. They're spending a fortune, I know, but you got to look past it. And remember, this video today, we're talking about stocks that you can buy and hold for life. Take them to the grave type stocks, right? So this is a short-term phenomenon that's going on in the business. You got to look past this. Next, this is very important. This is one of the most underrated things with Meta. Listen, Mark Zuckerberg, CEO of this company, right? He seems very committed to continue to lead Meta and continue to build this company for at least the next, I would think at least the next decade, if not the next several decades, right? He's 41 years old. That's insanely young. For a CEO, that's very, very young. So he's got a long runway if he wants to continue to lead this company. Think about somebody like Elon Musk. Elon's 54, right? Think about where Meta is going to be 13 years from now. Jeff Bezos, he's no longer the CEO of Amazon. He stepped away from being the CEO years ago, but from my understanding, he's still very involved with Amazon, so do keep that in mind. Jeff Bezos is 62 years old. And what about the GOAT, Big Buffett? He's 95 years old. So when you're buying into Meta, you're buying a gentleman with Mark Zuckerberg leading this company who has proven time and time again that he's a genius. Like, it's unbelievable. Like, think about where he started from that dorm room, starting Facebook, right? And then think about how many times Facebook had to pivot. Like, the Facebook you see today, dramatically different than the Facebook even 7 years ago, dramatically different than the Facebook you saw 7 years before that. Like, they've made tons of changes on that platform over time. Same thing with Instagram. I remember the first time I ever used Instagram, I can't remember what year that was. It might have been 2012 or 2013 or something like that. I remember the first time I used Instagram, like, it's nothing like it is today. Like, there was no Instagram stories back then, which is one of the biggest features on Instagram. There was no Instagram Reels back then. I can't even remember I don't even think they had messaging in Instagram back then. I can't 100% remember, but I do remember using it in like 2012, 2013. I was living in a 1-bedroom apartment, and I used to try to save on internet. So I used to steal people's internet back then. You know, a lot of people who wouldn't use passcodes. And then the other thing I used to do is I used to go down to the community center at the apartment office, and they had internet down there. So I used to have this like iPod, I think it was called an iPod Touch. And I remember I downloaded Instagram because I heard a lot of talk about it. And I was also researching Meta at this time because I bought Meta at that time. That was like $19 a share, right? Because it crashed and went IPO, blah, blah, blah. So I was like, let me look at this Instagram thing. It might have been 2013, sometime around then. And it was just crazy. Like, I just remember using it, and it was just like pictures of like nature and stuff like that. Like, it was just like random stuff. And like somebody took a picture of a building, and like, oh, somebody took a picture in the forest. And that's what Instagram was back then. You think about Instagram now, you go on there, it's like a whole different dealio, right? I'm sure there was that differences in WhatsApp over time. So the companies consistently pivoted, found other features, other apps, different things to do. They figure it out, man. And so just understand, when you're thinking about a company to buy for decades, you got to be trusting in that CEO. Next one up here, number 4 of these 7 stocks. This one might be the most controversial of the bunch. And you know why? Because the stock hasn't done well recently. That's how it always works, right? The next one, I tell you, this one's a great one to hold long term. Great one. Nike. 30,000% gainer all time on this stock. Number 4 of 10. Just do it, I call it. It's a $54 stock as of today. Okay. Not a lot of people understand what makes Nike so special, right? So what I'm showing you right now is Lululemon, from the highs it reached a few years ago when the brand was at peak. And since that time, Lululemon's lost almost 70% of its value. Lululemon built a brand on nothing. They fall into the same trap that company after company falls into. They build a brand on nothing. Lululemon, very successful yoga pants. That's not going to cut it long term. I'm sorry. Companies are going to copy your clothing, your apparel, and you're going to be odd man out, right? And so doesn't mean you can't have an existing company, but you can't be insane levels of 30,000% gains all time when you're a company that you build your brand on nothing, right? Look at Under Armour. They haven't been able to successfully build their brand over time, right? It's never felt like it really stood for anything. And you look at Under Armour since this company went IPO back in 2016, the stock price is down 85%. It still exists. You can go buy Under Armour clothes today. You can go buy Lululemon. You can go buy any brand. Or some do go bankrupt. But usually they can stick around. Nike doesn't just stick around. Their bad times are companies' like dreams of their best times, right? The amount of money Nike spends decade after decade, year after year on the brand of Nike is incredible. They're always focused on product innovation as well, which keeps them at the forefront of new technologies, right? I'm wearing my O1s right now. The technology is incredible in these. The O2s, if you know about these, they're incredible, right? But the brand, that's what's the biggest thing at Nike. You can innovate all day, right? Nike can spend fortunes on R&D. If you don't have a great brand, it's going to mean nothing in the end. And Nike spends more heavily on great athletes and the biggest sports in the world to always think of Nike as success, and that keeps them successful decade after decade after decade after decade. Like, Nike's still going to be way more relevant 20 years from now than it was 20 years ago or than it is today, right? And so that's what makes Nike really, really special. Now, additionally, when it comes to Nike, it's about a 3% dividend yield on the stock as of right now, right? That dividend is small compared to what that dividend is going to be 10 years from now, 20 years from now. Can you imagine what their dividend is going to be in the future versus now, right? And so all these other brands in the clothing space, in the athletic space, they come and they go, right? All of a sudden there's a new brand. Oh, it's popping off. Like recently it's been Aloe and Viore. I can already see it. The brands stand for nothing. 5 years from now, 7 years from now, they'll probably exist, but it won't even be relevant, right? And guess what? Nike in 5 years from now, 7 years from now is going to be way more relevant than it even is today around the globe. And that's because Nike does something no one else does. And they invest ridiculous sums of money right back into their brand again and again and again, nonstop. It's like a non-negotiable with the company. And that keeps them successful and relevant decade after decade after decade. And so that marketing spend is incredible. And it's just a force you can't compete with because no other company really wants to spend like that. And no other company, honestly, can spend like that because you're not doing $40-50 billion a year in revenue like Nike is and successful around the globe. And so they're a one of one. They're literally a one of one. You have if you look at all the companies in the clothing space, you have one company to buy, and that's Nike. You have another company you could buy, but it's not really a clothing company. It's more of an accessory company, and that's LVMH, Louis Vuitton. Louis Vuitton really understands branding very high, but keep in mind, Nike sells to everybody. Louis Vuitton obviously spends to high-income earners, the wealthy, and maybe people that want to look rich but aren't rich, right? So anyways, you don't have a lot of options in this space. There's very few companies that really understand branding and really understand you got to spend crazy money to stay relevant year after year, decade after decade. Phil Knight got that culture in this company a long time ago, right? Alrighty, guys, number 5 of these 7 stocks to buy and hold forever is Elf Beauty. This stock that has returned 206% all time. Elf Beauty, cosmetics company. The thing you gotta understand about Elf Beauty, why is it a great company to hold long term, is they've now reached, I would call it critical mass in the makeup industry. Go to your local Walmart and go look at the makeup aisle. I know 90% of the people that watch my channel, or 88%, I think it is. I think it's down to 88% of the people that watch my channel are men. You're gonna probably feel weird walking around the Walmart makeup area, right? Or the Target makeup area. Do it. And you're going to see, Elf is like a big player now. Like they got major shelf space. And the incredible thing about Elf is they're known as having really good quality products, but for very cheap prices. Like you look at most of the Elf products you're going to find at Walmart, Target, almost all of them are under $15 and many of them are under $10. Some even under $5 or around that $5 price point. So you're going to give you, like the customer base at Elf understands it's going to be good quality products that are marketed well and ultimately are very affordable. And so that's what makes Elf really incredible in the makeup and beauty space. And guess what? I think people are still going to wear makeup and still do skincare routines 10 years from now. And I think they're going to probably do that in 20 years from now, and 30 years from now, and 40 years from now, and 50 years from now, right? Till AI takes us over. Then we're all done. No, this is Elf's revenue over the last number of years. So 2020, $280 million of revenue, then $310 million of revenue, $390 million of revenue, $570 million of revenue. They cracked $1 billion plus in 2024, and then the past year, $1.31 billion of revenue for this company. They're also very well diversified now. They're not just counting on Elf's brand only. They now own Naturium, which is very successful in the skincare space, and now they also own Rhode, which is Hailey Bieber's company, which is a force to be reckoned with in the makeup industry, and watch out for them over the next 3 to 5 years. Oh my gosh. So it's not like you're just counting on the Elf brand. They now are kind of, I would almost look at them as like a conglomerate of very successful makeup and skincare brands now at this point in time. And keep in mind, these products are much higher margin than most industries, right? Now, Elf, this is a stock I've owned for years. Bought this stock in the public account way back in February 27th, 2019. And, still holding it to this day. And there's been a lot of ups and downs for Elf over the years, right? But there's a lot more ups than downs. And this is a stock I've been buying heavily in other portfolios as well. So I haven't bought any more in the public account because I actually was buying a lot of Estee Lauder and I already have a position here. But I own several $100,000 more of Elf shares that I bought in the past couple of years in other portfolios as well. And I look at this as it's $73 steal deal, right? Steal deal. Anything under 100 you can get your hands on with ELF, buy it up, right? These are my projections for ELF Beauty. Looking at 1000xstocks.com under the intermediate projections. We also have the advanced projections if you really want to go crazy with it. But here's my base case for ELF. 23% revenue growth on average. This year, they're going to have a huge bump up in net income because, a lot of one-offs are going away. And then after that, I have them doing 20% net income growth on average, right? 30, 35p. If you got those sorts of growth rates, you can command a 30, 35p in this space. And we're talking about, I get a CAGR here of around 30%. So, ELF is a steal deal. Right now, it's going to likely produce great returns over the next 3 to 5 years, but we're thinking about holding the stock for decades, right? I think ELF's going to be a pretty darn good one to hold for decades and decades to go in the future, right? All right, guys, next one up here, number 6 of 7 is Celsius Holdings. CELH is a ticker symbol on this one. It's a $43 stock. So Celsius, probably if we go back 7 years ago, right? Oh gosh, did I just do that? Celsius, no one heard of the company, right? Now you go in, now it's hilarious. If I drive by almost every convenience store or just any store in general, it seems like they have Celsius signs all over. It's like they want everybody to know, we sell Celsius here, right? And Celsius is now a big dog brand. They've now reached critical mass, and it's very important you reach that as a drink brand. If you stay niche, it's a tough space to be in. You got to get critical mass. And now Celsius has critical mass, and they're continuing to build the business aggressively in the United States. But the international opportunity for Celsius over the next number of years is insane for this company. Now, I know this space very well because years ago, I used to be invested in a company named Hansen's Natural Beverage, which nowadays is known as Monster, right? And with Hansen's Natural Beverage, I got to see how they expanded Monster in the United States over time, how sometimes they would go lower margins, so they'd do promos on Monster to take market share, and then they would, kind of lay off the promos once they had a good customer base, come in with better margin. I saw the way they expanded internationally, and I see Celsius doing a very similar strategy here that I think is genius. Now, they also own this brand called Alani. This brand's been growing like a beast the past 2 or 3 years. This is a brand probably no one heard of 3 years ago. And now, once again, there's another brand that you're starting to go in these stores and there's displays of this Alani everywhere and they're selling like crazy. I was at Costco just yesterday and they had several different pallets of Alani and they were doing numbers. The Ghost, they had Ghost Energy right next to it. It looked like no one was buying Ghost. And yet the Alani big cases, they were, let's just call it, worked down. And so Alani is a brand that continues to build out. And I feel like Alani's not quite at critical mass like Celsius is, but it's not that far away. And if Alani keeps building over this next couple of years, they're going to be right where Celsius is at, where they're going to be at critical mass. And once you reach there, then it's just about maintaining your brand relevance, and you can just put up great numbers year in and year out because you got a very loyal, great dedicated customer base. Now, additionally, they just acquired Rockstar Energy from Pepsi. This was a very successful energy drink brand, but then they got sold to Pepsi about 6 years ago. These companies like Coca-Cola and Pepsi don't know how to run energy drink brands. Coca-Cola tried it many times and then they just finally gave up and they partnered with Monster. And now Pepsi did a similar strategy over the past year or two and they realized, let's just get ownership of Celsius. They passed over Rockstar to Celsius now at this point in time. And so Pepsi is also a major owner of Celsius. And that makes for a great stock for years to go in the future because I don't think, ladies and gentlemen, listen, I don't think Pepsi wants to sell Celsius shares anytime soon because they look at that as a great opportunity to build their investment profile over the next number of years. And additionally, Pepsi is also a big distributor of Celsius. They're the big distributor of Celsius now at this point in time in their different products. So it makes sense that Pepsi is going to want in on the success of Celsius. So if Celsius goes from a $40 stock to a $400 stock over the next decade, I think Pepsi wants the upside of that, right? And so they're going to likely remain a major shareholder for, probably honestly decades to go in the future. I think the only way I could see them selling it off is in a scenario where Pepsi or Coca-Cola ever got desperate for money, and that's probably not happening, right? So the moral of the story is, because Coca-Cola owns a huge ownership of Monster. So anyways, now when it comes to this company, listen, if you think about holding a company for decades, drink companies are great ones to do, right? Coca-Cola has been an incredible investment over the last, 40, 50, 60 years. Pepsi has as well. Monster has as well, right? Now, Coca-Cola and Pepsi over the past decade haven't been as exciting of investments. And the reason being is like, it's just hard for those businesses are so big. It's hard for them to really grow, right? In the soda category, which is much of their businesses, it's tough to grow that business anymore, right? And so those companies aren't necessarily great investments nowadays when it comes to Coke and Pepsi. They are from the perspective of safety. But the exciting thing for a company like Celsius is it's still in that major growth stage, but it's also, I think, got a lot of protection around it because their brands are reaching critical mass. Celsius is already there, and Alani's probably going to be there, like I said, probably within, honestly, like 24 months now at this point in time. Now, when it comes to Celsius, $11 billion market cap on this stock. And think about the revenue opportunity over the coming years for Celsius, the margin opportunity for Celsius, and the profit opportunity for Celsius is immense. Celsius is a major position for me in the public count, up $76,000 on it so far, up 78%. Do I have any ambition to sell any of these 4,000 shares in the public count of Celsius? Absolutely not. I would love to hold this for years to go in the future. No interest in selling Celsius, because Celsius, the way I look at this one, insane growth for the next 5-7 years. And then I think after that, they'll start coming in with big dividends, right? And so then I'll be sitting on all these shares and start receiving a bunch of dividend money as well. I like it. I like it a lot. And I'll be able to take that dividend money, invest it into other companies at that particular time that I find as attractive stocks, grow, never getting scarcity mentality. Always be in abundance, ladies and gentlemen. Number 7 of these 7 stocks that you can buy and hold forever is Wynn Resorts. Wynn Resorts on this one, ticker symbol WYNN. This stock has given a return of 674% all time. That does not include all the dividends this company's paid out over time, right? Now, when it comes to Wynn, they have their incredible properties, Wynn and Encore. I was just down there on Saturday. I took my 2 oldest boys for lunch at Allegro. You might have gone there before at the Wynn in Vegas. And man, it was insane how busy it was. Like insane how busy it was. We went there probably around 11, 12 o'clock. Nuts. We went to Topgolf after. That was fun. And then they have 2 properties in Old Macau, very profitable properties. They have a Boston property in which they operate. They sold off the building and the land to another company, but they still operate that property. Then they have this beast, the Wynn Palace. I call it the last great building that Steve Wynn built, which is in the kind of newer part of the Cotai Strip of Macau. And they have their Middle East building. The Middle East building is kind of an old picture here. This is an update. So obviously that looks like a building that's going to be ready to open in 2027, right? This building, by the way, not as nearly as beautiful as other buildings. Other buildings are masterpieces, but part of the reason, in my belief, is keep in mind this particular building, they're only going to have a 40% equity interest in this particular project, right? So just something to kind of keep in mind there. But you got to ask yourself, why do people go to the Wynn and Encore? They have so many other places you can gamble, right? You can gamble so many different places. Look at the Strip. Like, there's no shortage of, like, why do people with big money, you got to ask yourself, why do they go there out of all the options they have? Because, one, it's a place to go. Like, it's just where the big money's at, where the celebrities are at. It's the place that you're going to get the best service, right? It's the cleanest, it's the nicest, the best food, the best clubs, the best everything, the best women. You want the best women, go to the Wynn too. Like, it's got the best everything. So if you got big money and you're into having some fun and you want to go to Vegas, you want to go to Macau, and soon in the Middle East, you're going to go to the Wynn and Encore if you're a big player. And so that's just how it is. And so that's a company I can feel comfortable investing into for decades to go in the future. Because guess what? People are still going to want to gamble 10, 20, 30, 40, 50 years from now, right? And if they want to do it at the best establishments in the world, they're still going to do it at the Wynn properties, right? They're still going to want to eat at high-end restaurants. They're still going to want to go to nightclubs and all those different things, right? Like, none of that stuff really changes. Like, we can go back to the 1980s. Guess what rich people like to do in the 1980s, right? We're in 2026. Guess what rich people like to do in the 1980s? Well, we're not going to get into everything they like to do in the 1980s, okay? But guess what? They like to go to great restaurants. They like to gamble. They like to party. Guess what they like to do in 2026? Stay at really nice places, eat at really nice restaurants, gamble. The same stuff. Decade after decade after decade, folks. So anyways, those are the 7 companies up there today. Hope you guys like this video. I hope you like these stocks. And if you don't, that's fine. I'll be the one to buy them all up, okay? I appreciate you for joining me. Thanks so much for being here, folks. Hope you got a lot of value out of this one here today. If you're looking to apply, join Private Stock Group, Private Wealth Group, take your investing game up to a much higher level than where you're at right now. Get access to all of my premium courses, access to my private Discord chat, access to 1000xstocks.com. I showed you a lot of 1000xstocks.com in this video, but there's a lot more to it than what I even showed you here today. That's going to be the main pinned comment down there. Click on that, fill the form, see if we can get you access in there. Maybe in the next week or two. Maybe. We'll see. And then, once again, second pinned comment down there is you want the Warren Buffett, Peter Lynch book. I think you'll learn a lot from those books, okay? Appreciate you. Much love as always. Have a great day.